Good morning. This is Ed Hamrick, Assistant Attorney General, and I represent State Board of Land Commissioners. Today is Thursday, June 15th, when the board has been in executive session to discuss upcoming non-simultaneous exchange transactions, that the premature disclosure of information related to those transactions might provide a competitive bargaining advantage to persons whose interests are adverse to the trust interest. The discussion was authorized under 246402(3)(a)(1) of the Colorado Revised Statute, and no decisions were made in executive session. The board is now back on the record and in open session and ready to proceed with its agenda. Thank you very much.
We are kind of moving things around a little bit. Nick, I don't see anyone online for.
We hadn't opened it yet.
Yeah, so far. Oh, and Janet. just
There she
joined.
is.
There's Janet.
So far, I concur. I'm just gonna check a report to see if.
Yeah,
You
just
have
because
something?
we're doing some business work for kind of a lengthy amount of time. If there's any public comment, it's just a little
Oh,
out
it'd be
of
great to get
order.
that out of the way if we were.
I'll ask.
We can do it twice.
later when we
Yeah.
do the official meeting, but if anyone didn't know.
There we go. We have our first attendee joining. We're good.
Okay, all right. So with that, without anyone else who seems to be online with us, we'll go ahead and turn it over to Director Ray.
Good morning. You're going to do the public session.
Oh,
We
I
need
can
to-
do that. Yes.
We need to start the new
We're
tape for
starting
you,
our
right?
meeting.
We're on recording. We're going with that.
Okay.
Let's go ahead and solicit for public comment on non-agenda, right?
Yes,
And then,
we have it.
no, that's good.
Yeah. that's
We
what
can
I'm
do it again
saying.
later, but if
I
there
think
was
we should
anybody
do it
sitting here
later,
waiting.
Just in case, I was just wondering if anyone was sitting
I'm
online.
catching up now.
Yeah, it's all right. Only because we're going to be doing a few of these items for a little bit of time. If someone came on early. All right, with that, I don't believe there's anyone online, but we are opening the meeting of the Colorado State Land Board. It's June 15th, 2023. We're in Pueblo, Colorado, and appreciate the tour and commissioning of the Thunderwolf solar site that we were at yesterday with Nextera and Excel once again. And we're going to move into a section of business items. Just, I think we need to do some scheduling with our panelists. And so I don't see any public comment. I'll refer to this again and mention that we have some online, but I would like to do that when we get to the real formal business. So with that, I think now we can get started.
Awesome. Nick, will you give me a slide deck up there? Janet, good morning. I can see your smiling face up there, and I'm going to introduce you in just a second.
Janet, if you'll just say something for me.
You want me to say something?
There you are.
Okay. Just
We can hear you now. Thanks.
great.
And do I have slide control from here?
You do.
Okay. Good morning, commissioners. For the record, this is Bill Ryan, Director of the State Land Board. We're joined virtually this morning by Janet Becker-Wold. She is with Callan, and Callan is the investment consulting firm that helps advise the Permanent Fund Investment Board and the treasurer on the permanent fund. We did invite both the treasurer and the deputy treasurer to join us today, but neither were available. So I hope you all had an opportunity to read the memos and the exhibits. I think there was some great background info in there, including the Common Fund report on managing long-term endowments. I thought that was a great piece. We've got about an hour and a half to cover some pretty heavy-duty, big-picture topics for the land board, some really foundational stuff for us. Get a little coffee, get comfortable. By the way, I've chosen the title, The Whole Trust here, because we're going to be talking about all of the assets of the school trust. And that includes the financial assets, the permanent fund. So normally this board just deals with the land and the minerals and the other real property. But this is bigger than that. This is going to be a discussion that includes the permanent fund. We're also going to discuss the distribution policies, because those have a huge impact on what happens to the corpus of the trust. So it's important that we understand all of this holistically, even though we don't control all of it. Nick, you promised me control. I do not have it. Will you advance the slide?
If you click the mouse, there you go.
I'll go back one. Okay. So for the next 90 minutes, we're going to cover a lot of material, and given the complexity and the importance, I'm going to chunk it into 4 major areas. We're going to talk first about governance and responsibilities, your fiduciary responsibilities for this trust. Second, we'll talk about asset allocation for the whole trust and the role of the permanent fund in that. Janet's going to be particularly helpful here. We'll talk about the distribution policies that govern how dollars flow to the beneficiaries, and perhaps, well, I've got a suggested distribution plan for policy that's more aligned with intergenerational equity. Janet's also real familiar with that as well. And then we're going to have a discussion of some next steps that we can take to improve the long-term stability and performance of the trust. Again, I mentioned the Common Fund brochure that was in your packet. And this quote was really meaningful to me as I read that. And so I wanted to call it out. And, you know, the staff here uses a public speaking coaching firm. I don't know if you knew that, but our folks at Articulate always say that I have to have a bang early in the presentation. And so here it is. This is what we're charged with as fiduciaries, and the bang is we aren't achieving this. We are benefiting today's beneficiaries at the expense of the future. You may have heard me refer to this previously as the trust is shrinking, and that's the way we need to think about it. The asset allocation and the distribution policies are out of alignment with what you ought to do for an intergenerational trust. And so, I mean, as I sit there and think about what future commissioners and future beneficiaries will think 50 years from now, you know, what are they going to say? Because I think we have an opportunity to try and fix the problem. In a lot of the ways, I feel like we're para right now, that they're in a hole. And they don't seem to be able to get out of it. And I feel like we are able to make some changes and correct course here that will enable us not to sort of end up in this same place. So let's talk first about your fiduciary duty as commissioners. This is our constitutional mandate. It's in our strategic plan. You've seen this before. Note that it includes the words intergenerational and endowment in it. I guess I want to call your attention to that. But again, a reminder of fiduciary duty, a legal and ethical obligation to act in the best interest of the trust beneficiaries. And then this concept of intergenerational equity, of balancing today with future generations. Let me ground the discussion also in our strategic plan. Our number one goal in the strategic plan, and we'll talk about this a little bit later, it was in your books for another item, is around financial trusteeship. And we said that means to protect and enhance the long-term economic value of the trust. So we'll talk about that a little bit more later with 23-24 goals, but I think this is the linkage of today's discussion to our strategic plan and to our business plan goals. Lastly, on this topic, I need to add an important contextual note about the governance of Colorado's school trust. It's really disconnected. So this board oversees some of the assets, the land, the minerals, and some of the other real property. The treasurer with the help of the Permanent Fund Investment Board, oversees the permanent fund. Those are the financial assets. So that's practically a third of the fund is overseen by a different group. And lastly, the distribution policies for this thing are set by the legislature with virtually no understanding of the assets, the income, the goals, the financial responsibilities of an endowment. Let's just say that that's not the way you would set up a successful long-term endowment, but that is the reality we live in. I don't know. There are some ways we might tighten that up a little bit, but it's pretty constitutional. And so that would be difficult to change. But again, part of the problem we have today, I think, is a result of this disconnected governance. So that was really all I wanted to say on the governance piece. Any questions on that before we move into meat and potatoes here? I hope that was good context and background. So we'll talk about the assets now and the allocation of those assets and the various asset classes and categories. So this is the school trust in total. There's about $2.5 billion in land on the right side there. That's 52% of the assets. In the upper left is the permanent fund, about a quarter of the assets. That's, by the way, a June 30th valuation. I think currently we're back up over 1.3 billion. We've got a commercial real estate portfolio. We spent a lot of time talking about that a couple months ago. That's 4% of the trust. And then we've got a minerals portfolio that's a little less than 20%, call it 800 million in value. I mentioned in the memo how we valued each of those asset classes, and I just briefly on the land, we use U.S. Department of Ag data. It's not perfect, but it's repeatable. It's broken down by land type, whether it's irrigated or ranch land. It's broken down. We can slice and dice the data reasonably well. And again, this is never going to be a perfect number. But what we've liked about using that data is it's published every year. And so it's repeatable. We can come up with a pretty consistent valuation process for that. For the minerals portfolio, we do a discounted cash flow of proven production. So there's not an effort to value non-producing minerals. I think there are a lot of oil companies that try and do that. We don't do that. We simply look at our proven production and do a discounted cash flow of that income stream. For the commercial real estate, we use appraisals when that's available and when it's timely, but we can also just use current market cap rates of our income streams. And then finally, for the permanent fund, and Janet will talk about this a little bit more, but that's just current market values. It holds equities and bonds. They mark to market every day. In this case, we use the June 30th valuation.
Bill?
Yes.
On the land value, is that consistent with our transactions that are happening now? I mean, does it match up to 2.4? Because we have examples.
Yeah, we do. I'd like to say that we achieve slightly higher than what the USDA values are when we go to sell something. Our general rule of thumb when we're a seller is that we're getting better than market value. That would be the impetus for us to sell. What's Matt's phrase for that? Matt LaFontaine calls it the seller inducement premium or something. But so I'd like to think that we've put those out in a competitive way and we're achieving at least what the USDA would say they're worth. And I think that's the case with all the transactions you saw.
You mean billion, or it's not million.
Well, it's 1,235 million. So yeah, 1.23 billion, 2.56 billion. Yeah. Let's look at that same information, but instead of value, let's look at it on an income basis. So what you'll see here is that the majority of our income comes from our minerals portfolio. Historically, that's 71% that year, but I would tell you over the long term, it's been roughly 80%. what you got to understand in the context that's important for this discussion is that minerals are an asset sale. Once we've sold the oil, we don't have it anymore. And I would also add that that revenue stream is likely to decline as Colorado and the country decarbonize. I say that every year and I'm wrong every year, but eventually I'll be right. You know, I've predicted 15 of the last 2 recessions, right? You know, right. As you've heard me say before, you know, we are highly minerals dependent right now from an income perspective. So here's those same 2 pie charts next to each other, right? And the key point is to really just allow you to visually compare them, the asset value versus income for each asset type. Later, I'm going to hope that this begins to make the case for moving dollars out of land, which is 52%, but only earns 14%. So again, this I hope helps demonstrate the imbalance between value and income. And because I know we have both left-brained and right-brained people here, I wanted to show you the same information in a slightly different chart. But that is the same data prepared in a grid. I do want to say that we're talking here about cash returns because I want to keep this apples to apples. So I'm not talking about total return, which would include appreciation. So if you looked at the 2.8% for the permanent fund, that doesn't include appreciation. That was the cash return, simple math of 34 million in bond interest and stock dividends divided by the 1.2 billion value. But with appreciation, that'd be a much higher number. And in fact, the S&P 500 10-year return as of March 2023, so that's including a horrible 2022, was still 12%. So our permanent fund return, even at just 30% equities, is much higher than the 2.8% you see there. And Nick, I have lost my controls. Mouse slide. How about that? There we go. That was I was circling the point I was trying to make about the permanent funds. So.
Hey, Bill, can I jump in here?
Yep, this is where I hand it over to Janet to talk in more detail about the permanent fund and what's in that component. Take it away, Janet.
Sure. Thank you, Bill. And thank you guys for letting me do this virtually. I'm actually on vacation day traveling to Southern Colorado, although not in the Pueblo area. So I appreciate being able to attend virtually. I want to just give you an update because there is some good news on this front. So this is fiscal year end through June of 2022. And we sort of track this income quarterly cumulative. You can stay on that previous page just for a sec. And just to give you an update on where we're on track for fiscal year 2023, in terms of the revenue, we're looking at revenue now off just the permanent fund of $37 million for this fiscal year end, if everything kind of stays on track. And there's a couple of reasons why we're expecting much higher income, and most of it has to do with the significant increase in interest rates that we saw in 2022. So the rather substantial allocation that the permanent fund still has to bonds, the yield on those bonds, you took a capital loss, but not realized last year, but the bond yields have reset much higher as those bonds mature. Their new bonds are being purchased at much higher interest rates. So it's going to throw off a significantly more income. So while bonds have been a bit of a drag from both a total return perspective and an income perspective coming into 2022, they're really making a contribution now, both on a return basis going forward and in income. So they're not as big of a drag. And the cash yield now would go from about 2.8 to roughly 3. So on the whole portfolio, just because of the bonds. So that's a little bit of good news. So we can go to the next page. So Bill has kind of framed the whole trust in the components of the lands and the permanent funds. So here we're just looking at what we consider to be the financial assets or just the permanent fund assets. So this is the current asset allocation as of the first quarter of 2023. So fixed income is still around 60%. Equities are 30%. And then we have a sliver of allocations of different strategies, including high yield and preferred stock, that allow us to keep the yield up. These are things that are really not meant to be capital gain oriented, but income oriented, because we wanted to put some kind of a floor under the distribution policy, which is the $21 million distribution to the School Finance Act. So some of this was constructed to generate some income, but the equities are clearly there to provide growth, and of course the fixed income portfolio. But just a little history. So if you go back to the legislation changed in 2016, allowing the permanent fund to invest outside of fixed income into equities. And Helen was hired in 2017, and at that time it was 100% fixed income. So it took us about a year to kind of get all the investment policies written and all the governance structure in place and all that. And we were hired and the board was put together. So there was a lot going on in 2016 and 2017. But in 2018, we went from 0 to 20%. And we did leg into that, but we did go from 0 to 20. So when you look at the performance figures going back 10 years, bear in mind that equities were only in the portfolio really for the last not quite 5. So we have made progress, and now we have gone to 30%. So we went from 0 to 20 and then 20 to 30. And those were not big leaps, if you will, but they were legged in over a year. The 20 to 30 took us 4 quarters to leg in because of market volatility. And we wanted to kind of dollar cost average it. So this has changed quite a bit in 5 years. Okay, so let's go on to the next page, maybe.
Gonna try. There we go.
Okay, so we show this, it's not directly related to the issue really at hand today, but it's an interesting chart that we show clients to get a perspective on what the distribution of equity returns looks like going back 233 years. So this is a histogram. So each year is stacked in a range, and the range across the bottom is the return. And then they're categorized by a range of returns. So what you can see is that this is not what we consider to be a normal distribution. That's where 0 is the peak and everything kind of tails off evenly on both the positive returns and negative returns. So returns are positive moving to the right on this chart, and returns are negative moving to the left. What you can see is equities have a positive skew, meaning they have a higher probability of a positive return. So that's why you can see these stacks more to the right of the 0 than to the left. So we want to kind of take advantage of that. So we've highlighted a couple of different years so you can see how bad things can be. Over on the far left, you can see the 2008 return. Of course, that was the great financial crisis, the GFC, when the S&P 500 was down 37%. So that's what can happen in equities. In 2022, as bad as it was down 18%. So not as bad as the financial crisis, but bad. So, but then on the other hand, you can see this string of different colors there at the top right, 2020, 2016, 2014, 2021, all these giant, very strong positive returns. So equities come with volatility. And part of the reason why we have been slow in adding equities to the permanent fund allocation, and we've been moving kind of cautiously, is that there is in the statutes that there is a gain loss provision that if there's a net realized loss in any year, the legislature has to make it up. So we've been kind of moving maybe more cautiously than Bill would like, but we're trying to make sure that we can manage that gain loss provision, because I can't imagine having to go hat in hand to the legislature and asking them to make up some money. So we've been kind of learning as we've been going along, but we have been increasing from 0 to now 30. But this is just to give you a sense of the risk and the volatility that can be associated with equities.
Janet, before you leave this slide, let me just make 2 points to you all. I acknowledge, commissioners, that's really hard to read, and our slide lady would hit me in the back of the head for this. But I circled the important point. The 10-year return was 16.9% through 2021. And even if you add 2022 as a crappy year there, it's been 12.2. That's the S&P 500 10-year return. So there is clearly an opportunity for growth. And the overall point of this chart is that while there is volatility, you get growth through equities in a portfolio. The second point I wanted to make, to expand on what Janet was just saying about the make whole provision by the legislature. This fund is a little bit unique in that it doesn't have ongoing obligations like PARA, for example, has to write out checks to the participants every year. Pinnacle has to pay out insurance claims. So it has to be able to get liquid in order to make those distributions. In this case, the corpus is inviolate. So we don't have to sell. We have a high degree of control about whether or not we take a loss in any given year. It is a choice by the people managing the portfolio to sell something when it is down. And given that high degree of control, it's my thought that it could take more risk, because even if the portfolio has a bad year, you simply don't sell. And so you don't therefore have to go to the legislature and say, oops, we sold at the bottom. Now, Janet's counter to that is we do have an investment policy that requires a certain ratio of equities to fixed income. But you can construct that policy to have pretty broad guardrails so you don't get out of allocation. And even if you did, you can sell different components of this to try and come back into balance. And in years when the land board dollars are not getting swept, the land board's actually contributing money that can go back in to create the balance that you need under the investment policy. So for example, if we said we wanted to be 30-70 and we got to 80-20, the land board is driving money into the permanent fund that could be used to buy the right asset to get back to the balance. So there are some unique pieces to this fund that I think allow it more flexibility and more opportunity for growth than it currently takes. Janet, feel free to rebut or disagree. You and I have had that discussion a lot over the years.
Yeah, everything you said is true, but in practice, it's a little more difficult, and it's hard to predict because of the volatility around equity markets. And no, but everything you said is absolutely true. What we have been holding off for a little bit more recently is 1146. Is that we were hoping that some of the constraints that currently sit in the portfolio that we find most constraining would be removed, and that the legislature would see fit to unwind some of the most constraining parts of it. We're still waiting for that. But in the meantime, clearly, we can still cautiously potentially move this up. You're right. We have intentionally wide rebalancing guidelines, so we don't force a sale when we don't want to force a sale. And we have had steady revenues from the land board, in which case we've been able to rebalance with those cash flows. So we haven't had a problem managing it yet in the 30, even given with a 30% allocation to equity, we could potentially move that up. We've been sort of holding off to get some results on 1146. And, clearly that's something we have to talk about if that looks like it's going to stall longer. So, but yes,
and that'll be in the
that is true.
Discussion here later.
Yeah. Okay.
Yep.
So let's move on to the next page. So we really are, we're trying to look forward, and as Bill is aware and the land board may be aware, we conducted a study on behalf of the land board in 2018 to look at many of the issues that Bill has outlined in his introductory comments. And so we've been, he asked us to look at those exact issues, the distribution policies, the investment policies, the governance, all these things. So we wrote a fairly detailed report highlighting our observations on all those key issues, which have been now ingrained into some of the 1146 changes. So we've been asking for these things for a long time and trying to get some of them. We've been aware of it and we understand it. So so on this chart, what Bill is showing on this page is what have the historical returns been? And again, I would caution you on the 10-year, but it's important. But remember, the legislature only approved this new asset allocation and the potential for equities and everything around it in 2016. So the implementation of the equities wasn't until 2018. So what you're looking at for that 10-year period is really 100% fixed income. Right. So, but the point is that you can't make money with 100% fixed income. You just can't. I mean, you have a 1.5% return there for the whole 10-year period for the fixed income portfolio. Now, the management of the fixed income portfolio by Treasury has changed a lot since 2016 in terms of how they view it. It's not a buy and hold portfolio anymore, the way Treasury manages it. And we worked carefully with Marudi and his team to move this to more of an absolute, a total return portfolio, because we knew that we could manage the income by having these other parts of the strategies, the high income strategies. We knew we could hit that 21 million with the dividend coming off the equity portfolio and the income coming off the other parts of the portfolio, that he could turn down a little bit the income generation component and look for more of a total return, because we wanted to capture more of the capital gains so we could grow the corpus of the trust. Okay, so but if you look at the 5-year period, here's what Bill's really is it kind of, I think, sticks in his craw a bit, is that we've got to, if you look at just the equity returns, this is a really good compounded annual return, even over 5 years, is 7.2% for the equity portfolio. But when you throw that in with the allocation to fixed income over that time, on average, the total fund is still not much better than the 10-year. Because the returns, even though we were getting higher returns in the equities, they weren't in a big enough allocation to really move the needle in a big way on the total return. And again, the total return and the income return are both important for us. Income return because of the distribution policy that we're subject to, and the gain that we want to grow the trust to ensure that we have enough in assets to be a solid intergenerational trust. So we want real distributions to be the same. So we have to grow at least the rate of inflation and student population growth, which is how we think of intergenerational trusts that support education. We work for the state of Idaho that also has a similar mandate. They have more beneficiaries. They have 9 beneficiaries, but the largest is by far public schools. So we're used to kind of thinking about this, not just nominal growth in the sense of keeping pace with inflation, but also making sure we're keeping pace with student growth in Colorado, so that per student, real growth is what we're trying to achieve to get to that intergenerational equity goal. Okay, so but 5 years, you can see the equity portfolios have added value. If you look over the 3-year period, 16. So even given 2022, the 3-year numbers are very strong for the equity portfolio. But again, you can see that we actually have negative returns over the last 3 years from the fixed income portfolio. And most of that is due to last year, because interest rates went from, 0 to, the Fed funds rate went from 0 to 5.5% or 5.25%. And of course, the Fed just held steady this yesterday, but that was 10 consecutive increases in rates, which, was very dramatic and hit the bond market very hard. So we have capital losses now sitting in the bond portfolio, but the silver lining to that is that we're getting more income from it. So we kind of ripped the Band-Aid off in terms of interest rate increases that caused us unrealized capital loss, but we're getting more in income. So there is a silver lining there, and our going forward expectations have increased. So let's go to the next page. So looking forward, and I think this is really important for us, is that we shoulda, woulda, coulda 10 years ago. That is, yeah, we should have maybe, it would have taken a lot of things that didn't exist 10 years ago. So it is hypothetical, but it's an important one to keep in mind, is that what can we expect now going forward? So every year, Callen generates our own proprietary capital markets expectations. So we sit down and we think of where do we think the median return will be for US equity, non-US equity, all the components of your portfolio here listed on the side. We've included some others that that may be considered in the future, which is private infrastructure, real estate, private equity. These are things that other long-term endowment-like funds invest in that you are prohibited by some statutes from investing in currently that we're hoping 1146 might address. But just to give you some perspective, so if you look at the first column here that says 1 year arithmetic, an arithmetic return is what you would get in a given year, independent of what the next year does. So, but what we want to know is what is the stream of compounded returns look like over 10? And that's the focus right here of the 10-year geometric return. So to give you some perspective on what happened with fixed income, you can see here that we're expecting about a 4.25 roughly return for a 10-year period going forward, starting in 2023. To put that in perspective, in 2022, that number was 1.75. That's how much moved in a single year. And that's very unusual for us to move our capital markets expectations that much in a given year. The important thing for the permanent fund is that our 2022 expectation for the total return of the permanent fund over a 10-year period was 3.83%. And that was in 2022. Fast forward to 2023, and given our new capital markets expectations, our forward-looking return is 5.8, so almost 6. That's a 2% increase in the expected return in a single year. And all that is due to the increase in the fixed income expectation due to what the Fed's been doing in rates. So the market is with you a little bit. It's helping that bond, even though the bond allocation arguably is high, it is at least now expected to make a much better contribution to the total return. So the drag that it has been abated somewhat going forward. So let's look at the next page. And Bill, and I think I'll stop on page 17, right? And turn it back.
Fine. Yep.
So in the study that we did for the land board back in 2018, we did take a look, and this is some refresh numbers that Bill and his team put together. So we take no credit for this, but we always, we do keep in mind what are other plans doing? And of course, the one that I'm most familiar with is Idaho, because I work for them. And they have had a pretty phenomenal return, but they also have a very risky portfolio. Their portfolio is almost 70% in equities.
So we're down here at Idaho.
Yeah, so Idaho is right there.
7.6% 10-year return. They have a 23% allocation of fixed income and 2/3 allocation to equities.
And
But
that,
look at their 10-year return.
right, and that last 10 there is commercial real estate, a diversified portfolio of commercial real estate. So, but the one thing that I do want to make sure that the land board is aware of is that Idaho can take this much risk because they have a very different distribution policy, and they keep reserves so that they can meet their distributions. So it acts as a buffer to the volatility that they're taking with the high equity allocation in the permanent fund. So they have a mechanism that surrounds the fund that protects it, protects the distributions so that the volatility doesn't play through by holding reserves. So they have a much more complicated distribution policy than you do. So that allows them to do that and still sustain pretty stable distributions, which is important in Idaho, and I'm sure it's important in Colorado, even though it's not as big a percent. I mean, Idaho is much smaller than Colorado in terms of its, school budget, but it's still pretty small part of the school budget in Idaho, and it's a very small part of the school budget in Colorado, right? It's so Colorado, they get that 21 million, or we've been able to get it up to almost 30 million, but it's still not moving the needle in terms of making a dent on the school budget for the state. But anyway, so you can see what other states are doing. Some are still pretty conservative. One that's not on here is Montana. Montana and North Dakota have a little bit more conservative too, but you can see that the ones that have higher equities have higher returns. That sort of follows, right? So I'll stop there, take any questions, turn it over to Bill.
The last two lines here, the common fund study, I mentioned these in the memos, but that's a study of more than 200 large endowments that's conducted by Common Fund every year. NACUBA is the National Association of College and University Business Offices. So that's largely university endowments. It's like 800 of them. And again, I want to show you that they've got high allocations to other asset types and to equities and low allocations to fixed income. And their returns are all, everything on here is over 7 on a 10-year return. Ours is 2. So I think the point I want to make is a higher asset allocation to equities and to other diversified investment asset classes seems to yield a higher return.
2.3 doesn't even cover inflation.
Correct. Certainly not today's inflation. So I want to try and drive home this point for you in one more way. Just for fun, I went and built a little model that said, if we'd had the ability to invest in equities 15 years ago, and we had decided to just do 50% equities and 50% bonds, and the indexes I used were the S&P 500 for the equities and the Barclays Aggregate Bond Index for the equities. What would that have done? Keeping everything else constant. I knew the starting point for our permanent fund. I knew how much we deposited every year. So all I did was assume that whatever money was in there went 50-50 every year. And then how much would it have grown to and how much would it have thrown off? The reality is that today we're at 1.3 billion in the permanent fund. It would have grown to 2 billion. It would be 47% larger today. And because the S&P 500 has a dividend yield and bond yields were fairly low, it actually would have distributed almost the exact same amount of income that we did distribute over that 15-year period. The permanent fund has thrown off 400 million to beneficiaries during that time. My hypothetical one would have yielded about the same benefit to beneficiaries. And again, at the bottom, I was highlighting the asset allocation. As Janet mentioned, for a long part of that period, we had no allocation to equities. Now we're up to 30%. In my hypothetical, we were simply 50-50. So,
Hey, Bill, can I just throw in one comment here real quick?
Yeah.
One of the things I failed to mention earlier is that one of the other things that kind of drags the return of the portfolio, not as much as the asset allocation, is the fact that you're sweeping all the income and you can't reinvest it. So, but that's related to what you're getting to next, which is going to be the distribution policy, is that if you distribute, if you have to sweep all the income off the portfolio and send it out the door, you can't reinvest it and if you can reinvest it, then the fund can compound at a higher rate because you have, you're putting the money back in, you're recirculating it. And then a distribution policy based on a percent of that over time would increase the distributions and allow the fund to grow a little bit more because of the reinvestment of the income.
I have a question, and I don't know if it's a fair question for Janet, but if we got rid of the 21 million requirement, which there was much discussion about, what's a realistic percentage to increase our equities to? I mean, I think we're kind of stuck with this fixed income thing. I don't see us getting a lot of diversity rolling with the current, how we currently manage the funds we manage out of the treasurer's office, but what would be a reasonable percentage increase to that?
I think that's a Janet question.
It's a Janet question, but it may not be a fair question.
If you weren't solving for a guaranteed 21, could you increase the allocation to equities?
Well, yes, the answer to the short answer is yes, but then it comes with those additional complications of the gain loss provisions. So it's if we had a clean sheet of paper, if everything that is sitting on the books right now was just magically removed, we would go to probably a 60-40 or a 70-30.
Okay.
Because that's where you have, but we would also want you to do something that would be a wrap like what Idaho does that could protect it if you were going to go to that much equity. Without having sort of a reserve fund and a little bit more complex distribution policy, you could go to 50-50 for sure. And I think that could be managed. The distributions could be managed. But everything here you change one thing, it hits something else. There's no way that you can move one piece of this without impacting something else in this portfolio because of all these statutes and the constitutional and the Senate bills, and there's just so much that surrounds this that one move can impact something else. So
Janet, I'd just like to
seems
add to
simple,
that
but-
answer
Yeah.
that I think even if the 21 million stays in place, because bond yields are so much higher now than they have been, you could achieve the $21 million with a much smaller allocation to bonds because the yields are higher. And so I still think in a higher yield environment, we can still drive more money to equity.
Well, this year will be kind of the first test case of that. We're expecting 3 million more in income. So if we have to distribute only 21 million, but remember that 21 million goes to the School Finance Act, and then the next part of the waterfall goes to BEST. So what we've been trying to do is make sure that we have additional funds that go to BEST.
Though those funds aren't guaranteed like the School Finance Act,
Right.
like the 21 million is. So.
They need a different reserve.
So again, to look at this holistically, let me shift gears now to the distribution policy. Move the mouse and hit the button. Distributions. All right. On the screen is the current statutory set of distribution policies. I think you've all seen this pictograph before, but from the top, that is our operating revenue from the land board. That's our leasing revenue and our royalty income. 50% of that goes off to the left and goes straight to BEST. From the other 50% going to the right, we pay our operating expenses and our asset maintenance costs, and the balance is supposed to get reinvested into the permanent fund down at the bottom there. Unfortunately, that distribution stream seems to be a frequent target to go to some other educational use. So rather than remaining as part of the long-term corpus of the trust for future generations, it's getting grabbed and sent to today's things often. You've heard me refer to that as the sweep. That occurred just 2 years ago, most recently. But there have also been a bunch of recent examples for programs that were proposed by legislators where we had to go play defense or get lucky at the ballot box. Amendment 123 a couple of years ago that was backed by Gary Community Investments was an attempt to permanently divert some of that revenue stream. There was a senator a couple of years ago who wanted to come up with a teacher bonus fund or a teacher pay raise fund. This is always the target here. And so, this is the pictograph depiction of the sweep. The other important, I guess, I want to leave you with, there should be more money going into the permanent fund every year. And the money that is getting to BEST is generated primarily by our minerals portfolio. Again, so I mentioned earlier that asset sales are happening and then we're distributing that money. Think about it in your own personal life. If you were selling off assets and giving the money away, your net worth is shrinking. That's what we're doing. And in years when there is no money going into the permanent fund, you're really, to use a farmer analogy, you're eating your seed corn. There won't be stuff for the future generations. So just to make that point even further, this year's legislative session did grab $10 million that should have been going to the permanent fund and is directing that to solve a funding gap at BEST. So we are going to make a very large distribution to the permanent fund this year, but it's 10 million less than it should have been because somebody said, well, BEST has these funding shortfalls, so let's just grab 10 million out of the other side. So this distribution formula leaves money sitting over here that looks like just a slush fund to legislators, and that's a frequent problem for us. Instead, let's look at how a typical long-term endowment might set this up. Here's an example of distribution policies that's used by a lot of long-term endowments. In this example, all of our operating revenues would flow directly into the permanent fund. So up top, here's our operating revenues. We pay our own overhead and I&D expenses, and all the money goes into the permanent fund. The spending formula then would be a rolling multi-year average of the value of the permanent fund. In the case here, we made up a number. We said 4% of a rolling 3-year average market value of the permanent fund. Josie, I suspect the Boulder Community Foundation did something similar. I'm guessing the University of Colorado does something similar. But there are a bunch of advantages to a formula that looks like this. First, you're linking the distributions to value, not to revenues. And that's really important because our revenues are volatile, they're mineral-based, and they're expected to decline. Second, by using a rolling multi-year average of the fund value, that provides a smoothing effect for years when the value of the stocks or bonds swings dramatically up or down. So this multi-year average helps smooth the distributions. Third, a formula like this creates more predictability for BEST and what they're going to receive every year, and it makes their budgeting and planning easier. They don't have the volatility as to what's going to come in that they can then go leverage and grant out. And fourth, and I think most importantly, it aligns a lot of interests. A formula like this, as the permanent fund grows, so too will its distributions, right? Grow the value, so the distributions get bigger. So both current and future generations benefit. I think that's a wonderful alignment of interests for our mission. So I do want to acknowledge, as Janet talked about, there are some challenges to making this transition from the current distribution policy on this page to this one. And these include, one part of it is that our distributions to BEST, part of that is used to pay debt service on tax-exempt COPs that have been issued by BEST every year. There are some IRS guidance about what the components of that debt service can be made up of. We should confirm with the IRS that this new methodology would work. The state went and asked that 15 years ago when they were creating BEST. But I would tell you that, in my opinion, the facts on the ground have changed. Where our income comes from as an organization is very different today than it was 15 years ago. I think we ought to be willing to go ask the IRS, hey, if we made this switch, does it cause any problems for the tax-exempt COPs that have already been issued? Because we don't want to upset those. And that would be, frankly, a non-starter with the legislature. But
We mean the treasurer.
well, we could mean us. We could mean the treasurer. I got to imagine it's, by the time we got some good tax and bond lawyers on this with the right political connections in DC, we're using outside counsel, and, maybe we spend $100,000 on that. But I think the long-term benefits could be huge if we can get approval to shift to something like this.
Point of clarification, the COPs, as you call them, those are issued in conjunction, basically to cover the timing differences of a BEST, a BEST contribution, and then they need more money?
Not exactly. When a school district applies for, say, $30 million to build a new school, that is funded by bonds, and the bond repayment comes from two sources: the local match, so there are local property taxes that go pay, and BEST is paying back bonds. So our dollars that we give to BEST go to pay the debt service on the COPs. And the IRS has some opinions about, if you're issuing tax-exempt COPs, I don't want to go down a rabbit hole here, partly because I'm not nearly smart enough.
Clarification on.
Yeah, but that's what's happening. So to build big schools, they issue bonds. To do things like fix the roof or upgrade the security and safety systems, they just do cash grants. That wouldn't be impacted by any of this, or shouldn't.
Well, on that point, what would keep us from making that inquiry now?
resistance from the treasurer's office.
But why can't we make that?
We probably could, but it gets pretty political because we're really impacting. The CDE ought to be at the table. That's who's issued the COPs. So I don't want to get too far ahead of the treasurer's office and the governor's office and the folks who've issued the COPs. I'd want to know they were on board with us asking. Doesn't mean we're going to make a change, but asking the question is a fairly extensive and expensive and lengthy proposition. So I don't think it would be in our best interest to go freelance that, I guess. Am I answering your question?
No, I kind of don't either, only because what would be our end game? You know, if the treasurer's office would not be on board, and I don't think they would be today,
Right.
then we can get all of this, but it may still not result in any real change. And so you want to know if you're spending $100,000 to get a question answered, if there's an affirmative response, that you can actually use that and go forward. And I don't think we have quite that.
And also, that's one piece of sort of a complicated political
Right.
strategy here that you wouldn't want to blow that bullet, line up the opposition. I mean, it's kind of part of an entire strategy.
Yeah.
Yep. The second piece that you've got to solve for if you're shifting from an old distribution policy to a new one is Best wants to know they're not going to get less money, right? Now, I think that's a solvable problem, as Janet talked about in the Idaho example. We can create a reserve fund. We could also alter this formula. So maybe it says that it's 5% for the first 5 years while we're making the transition. But when the permanent fund grows enough to keep it stable and consistent. So I think that's a solvable problem, particularly in years like now where we're making gobs of oil and gas revenues. We could set aside money into a reserve to make sure that Best got some minimum amount every year. It seems very solvable to me. So that's sort of the end of the first three parts: governance, asset allocation, and distribution. And we're about an hour in. I wanted to try and spend the last hour making sure I'm not just throwing out problems here. I want to offer up some possible solutions to this and make sure we've got some time to talk about some of those things. And again, this is an information item. We're not voting on anything today, but I do want to see if I can get some consensus on some directional things for me and the agency for the coming year. So, but we've talked about really the two most important levers that will affect the trust for the long term: the asset allocation, the distribution policy. So here's a few of the ideas, and these are in your book. Nick, if you can drag the people to a different corner. So one would be to set an optimal balance for NSE funds that would be held by staff to pursue opportunistic acquisitions. Maybe we say 20 or 25 million is the right number to keep around. If we see great ranches or great infill potential or a great water asset, we probably ought to have money available to do that. But we just say, hey, let's set a limit of 20 or 25 million. And anytime we have more money than that, we're going to drive it to the permanent fund because we think the yield and the growth opportunities are good there. So that would be one idea. Basically, we're committing to moving excess NSE dollars out of land and into the permanent fund.
Bill,
Yeah.
Are you suggesting we eliminate that 2-year limit?
Yes, we don't have to do anything statutory. You all as a board could direct the dollars from a sale go straight to the permanent fund and don't sit in that purgatory.
2-year.
Yeah.
So it can go beyond.
A second one. Help me, Nick. Lifeline. There we go. We can try and pass a board resolution advocating for the Permanent Fund Investment Board and the treasurer to increase the permanent fund allocation to equities. That would enable us to achieve more rapid growth of the permanent fund and attempt to keep pace with inflation. As you've seen, the portfolio isn't doing that yet. Again, we can't directly influence that, but we could make our voices heard with the treasurer and the Permanent Fund Investment Board. A third opportunity here, we could advocate for legislative changes to broaden the allowable investments for the permanent fund to include asset classes held by other typical endowments. We've tried to, I think, Commissioner Scanlon, from being on the Permanent Fund Investment Board, we've tried to buy into real estate as an asset class. Almost all of that is structured, private real estate is structured as a partnership, and there's a prohibition on the state being invested in partnerships. There's also a prohibition on us owning individual equities. Not that we would want to go long on an individual stock, but just some loosening up some of those restrictions would give the permanent fund broader investment authority. I also want to touch on one thing while we're here that came up as part of the 1146 report. I've thrown that phrase around a couple of times. All four of you are familiar with what that was, right? We've talked about that enough. There were two recommendations made in that report that had a pretty broad consensus. One is the next recommendation, removing the $21 million School Finance Act guaranteed payment. But there was a second one around trying to use some of those dollars for impact investing. And what we heard at the very end of the last permanent fund meeting, some members of the public got on the meeting at the end and said, oh, by the way, we've asked a foundation for some money to do a study of how we can go use the permanent fund for impact investing. Now, to me, impact investing has always had a definition that was around trying to achieve a social outcome at the expense of a lower return. So an example might be we use the corpus to make loans to build teacher housing. And we do that at a below market interest rate. Again, I'm not saying that's what they're proposing, but I could see an example like that coming forward. I think we ought to oppose that kind of stuff because I think you're getting into higher risk and lower return. And you're getting in, if the permanent fund is a lender, who's overseeing that? And what happens if the loans go bad? Does the legislature have to make up those losses? And I just think it becomes a slippery slope, but you all need to know that that is percolating out there among some powerful interests. I don't have anything more to report to you.
It was a public meeting. They were on publicly. So, there was a push with the task force to include this impact investing idea in the report. And Gary Community Foundation, Don L. K Foundation, they play big in the education space as well as other spaces were on. And so them expressing an interest in this means there's probably a serious proposal to be had in the not too distant future. So it wasn't random people in the public. It was actually
influential members of the education community.
Philanthropic community.
I don't understand what the proposal is yet because they haven't. Yeah. But it's hard to see how that's going to align with our fiduciary duty, particularly fiduciary duty for tomorrow. But we've got
I would
to
just say it is amazing to me that could even go anywhere when the permanent fund managed by professionals can't invest in things that other endowments are investing in, but it might go off and do impact investing. And I will disclose my bias. I've been in this world for 15 years now. I have a lot of opinions on impact investing. Could lead me to suggest we should be very obstreperous and resisting this.
So know that that's out there. A fourth thing that we could consider is to seek legislative support to remove the requirement for the $21 million guaranteed distribution to School Finance Act. Janet's talked about that as a huge constraint on the asset allocation of the permanent fund. The removal of the guarantee would really allow a much more flexible asset allocation strategy. Again, that's got to go through the legislature. The 21 million is in statute. We'd have to get somebody with the chutzpah to strike that. but I think the time is right now. I know my own property tax bill is up dramatically this year, which is going to result in much higher revenues to education. There's also been a whole lot of education funding coming at the federal level. So when the powers that be scream, this is a cut, I don't really think that's fair. And now may be the time to try and take that on. But that will be, when this gets proposed, you can all imagine that there will be some who scream, this is a cut to education. And that's not what it is. It's a way to achieve growth and higher distributions. A fifth thing we may wish to pursue is to advocate for statutory changes to the distribution policies. Again, I mentioned that as part of doing that, I think we got to run down the IRS issue. And maybe we want to choose to invest in something like that in partnership with the Treasurer's Office and others. I think the and others is important. I'm not sure we're going to move the treasurer on our own. But I think advocating for a change in distribution policies and this would be a big strategic seismic thing. It's complicated, so it's going to take the right leadership to get done. Sixth, while we're working on number 5, there's still the bucket of money flowing to the permanent fund every year that looks like a rich target. And so I guess I would characterize 6 as play aggressive defense every year and actively oppose any effort to sweep or otherwise redistribute the limited dollars that are going to the permanent fund now. I would tell you that the efforts at the sweep and the redirect are always done behind closed doors. I find out late or not at all. Folks, I think, know my position on the issue, so they just don't tell me they're doing it. And for example, the 10 million this year, I heard wind of it and I was calling the people who made the statement and they weren't sharing. And so it wasn't until the 11th hour that I even knew the dollar amount.
I think that aggressively opposing that is hard.
I agree. It requires friends in high places.
It does. And I think the reality is once they set their sights on it, if they have a coalition in the legislature, it's sort of doomed because they're going to get it through. And when we don't know it's happening, and I called the speaker, she didn't know it was happening.
Yeah.
Then it's really hard to have a strategy.
I think that was all, I'm sorry, cost overruns with BEST. I mean, just because every school district
they were careful to use the phrase inflationary pressures and inflationary environment and not cost overruns. But yes, that was the source of problem.
But again, if you had a reserve for BEST in general that helped with some of these kind of unknown factors, I can't fault them because it's been a little crazy lately, but that would just be a good idea. I mean, it's probably just a good idea.
I mean, the way you go build the schools, right? If you think about this, first, the district applies for a grant and they may get it in the first round or it may take a second year. Then once they have the grant, they go to their citizens and say, we're going to need a local match. The BEST grant required a 30% match. So we're coming to you voters. So that takes another year. Now you know your sources of funding, and only then can you get really accurate cost information. And in an inflationary environment, like I totally understand how it happened. The question is, how are they dealing with it? And as Commissioner Scanlon says, if we could get BEST to create their own reserve rather than.
And we could fund it. I mean, there's a partnership
Right.
that could be really collaborative. We just have to be a little more creative.
Yeah.
So I have a question for Janet. Is she still?
Janet, are you still here?
I'm still here.
Yeah, Janet, hi, this is Commissioner Frobe. Question, at the foundation of some of these, of the challenges and therefore some of these recommendations is a broader understanding and support for this notion of equity in an intergenerational equity trust. And so my question to you is, with Callan's work around the country with all kinds of different types of endowments, putting aside a little bit pension funds, but I suppose including them perhaps, what do you have any experiences to share on strategies that helped a broader set of constituents and stakeholders understand this foundational concept of taking today in a sweep or anything is robbing the future generations? Like, have you had any success in changing hearts and minds on this?
Yes and no. I mean, I work with a land trust. It's a private land trust. It's a hospital system in Hawaii who just happens to have just a huge amount of land that was left to them. And they had to deal with this issue. And they surprisingly got people on board because the mission was healthcare for Native Hawaiians into perpetuity. And so it was a very clear mission. It was a hospital system. So they kind of all got on board. Idaho had your same problem, but they took care of this 20 years ago. So they sort of struck while the iron was hot and got some of those statutory things removed. So they didn't have to deal with some of the things you're dealing with now. It's just, I think you're doing what you have to do. It's just, and because they're statutory, it makes it more difficult because you have to go to voters, it makes it more tougher. But most of these endowments, if you look at university endowments, which is a lot of the endowments we work with, or foundations, they've cracked this nut a while ago, right? All of them have distribution policies that are for foundations, they were, it was really prescribed because under tax code, if you're a foundation, you have to distribute 5% every year. And so they had to deal with this issue early on because that was tax code. So they were forced to deal with it. The endowments aren't forced to deal with it from a tax code perspective that have adopted that 5%. So they sort of got on board pretty early on because they saw the foundations doing it and they saw, well, it's 5, 4, 5.5, depending on, the university, but they kind of get it too, because they need to support university operations. They need to support students, grants, et cetera. So most of these institutions were born and raised that way. It's the land trusts that have the trouble because they have to go back and talk. People that put this legislation in place are long gone. So now you have new people that don't really understand what's going on in the legislature. And so the education is long and hard. And I think that's what you're discovering is, I know that Bill has been trying to do this at least since my tenure with this organization and probably prior, from 2017 on. And we've made progress without a doubt, but some of the more difficult things are still kind of stuck because of this legislative and constitutional things that have to be changed, that it takes a while to get people to understand why this is important. And if you have a big constituent that's speaking loudly to the legislature that is worried about this shift, and Bill sort of alluded to this, and when we did our study back in 2018, we looked at that shift. So if you shifted from this to a new asset allocation that was a 60-40, you got rid of all, it was just, if we could just magically wave a wand scenario, and we could show the distributions growing dramatically over the next 10 to 20 year period. But what it did involve is going below the 21 for the first year and a half. And that was just enough to grind it to a halt. Because no one wants to give up something they have. That's hard. Even if it has a benefit down the road. So I'm not answering your question, except to say that where we see the most of these issues are in the land trusts.
Right. Well, and the School Finance Act is like $8 billion.
13.
Oh, all right. All right, I was 8. It's not, 21 million is a couple of pennies. I mean, I think there's a psychological thing to it. There's a lot of, reactive kind of emotions associated with that.
Let me put the last one up here and then we can sort of digest them all. And that was, there it is, maybe improve the governance coordination. And again, I mentioned at the beginning, this is hard to do because the governance is set out in the Constitution. But maybe there are some key legislators who will get this and can advocate for us. Maybe there are some really good folks in the education community who can get this and advocate for us, some influential voices. There once upon a time was a advocacy, I guess I'd call it advocacy group that is sort of dismantled for a number of reasons I could get into later. maybe if we can rebuild something like that, but part of that, while that sounds easy, the reality is that the different constituencies within education have different desired outcomes. There are some organizations that would like all the money in the world now. There are some who understand putting some away for future generations. So just aligning in education isn't going to occur. So we have to find the smarter and more influential and longer term thinkers. And so that is sort of the end of my presentation. I just want to now kind of have a discussion about things you would like me or us to do as an organization to try and move this ball. Because I don't feel like I've been very successful.
I'll let Josie go with that. I just
We take
have
a
a
break.
clarifying
A few
question.
minutes. Take a
Yeah,
break.
we're going to lose Janet
Oh, okay.
at 9. Janet, you're leaving at 9:30, right?
Yes, I have to leave by 9:30.
All right.
Got it.
We
Can you
will
hold
take
in
a
for
break.
like 3 more minutes?
Yeah.
14.
Just a clarifying question. Are these all statutory changes?
No, directing NSC you can do. Advocating is really just a position
Yeah.
paper with the treasurer. Broaden allowable investments is statutory. Removing the 21 is statutory. Distribution policy is at least statutory. Resisting efforts, I think, is just we
It's just a
can,
strategy.
yeah. And governance coordination would probably be constitutional. And so
I'll just note in our task force, we've ruled out anything that would have to go to the voters to change the
Right.
constitution. It's hard, it's expensive, it's unlikely. It's too complicated to get I think, an app.
And to be real specific, the clause that the legislature has to make up any losses, that is constitutional. How we've been able to water that down over the years is twice now I've been able to get legislation run that defined loss in a way that it was a realized loss, not an unrealized loss, and gave a 12-month look back and an 18-month look forward to offset it with gains, realized gains. So we tried to define loss in statute in a friendly way, but removing that clause altogether would be constitutional. And our group
Just to
said,
clarify
don't
that,
do
I
it.
don't think we should
No,
talk about it because I don't think that's real.
There's a constitutional statutory split in the governance coordination. There are probably some things that can be accomplished statutorily.
Yeah.
Something. Other one.
yep.
Sorry, Josie, just interjecting.
So I've been thinking about this for a long time because for all of us, I mean, we have been tossing this around probably from the moment we came onto this board. And it's my experience when you just can't crack something, it is because your reality is not everybody else's reality. And for some reason, the folks who ought to be advocates for this are not either getting it or they see a different set of circumstances. So I think if we really need to deal with this, and I feel like we do, then we've got to rethink this in terms of who the beneficiaries are. And, you know, we're going to have to strategically work with those people who could best be our allies. Because right now, I mean, smart people in the legislature either have more on their agenda and they're unwilling to kind of spend the time on this, or the advocates in the education community see the immediate reality of it sounds like cuts. And so we've got to rethink how we frame this and really listen to what it seems like in their minds as we try to put forth what we think is a realistic agenda. Because I think starting the whole thing where maybe it was Janet had the chart, you know, we're making 2% and all these other states are making more. That's just such a, it's your bang that your speech coach or whoever said you should have. So people looking at that have got to go, wait, what's happening here? And then there's gotta be reality for them of what's different for us and how can we deal with that? And so I feel like some of these things we can do strategically. I agree, changing the Constitution, those things, I mean, we need to put that aside, but the things that we can really address, I think we gotta spend some time thinking about who are the players? Right. And how can we bring them on board or understand why they have such an objection?
And our biggest benefit, I agree, our beneficiary is best. Do we meet with that board ever
I'm
or,
not on board right now.
so they don't want to listen to us?
No, and
They're nervous. Yeah, I would, and I get it.
they are.
And they have
and
concerns, and I think that's constraining their thinking to what Josie's point is. You prioritize your own interests and then it kind of
Yeah.
shuts down.
And in these kind
perspective.
of tough days, especially for education, it's like everybody's fighting for these few crumbs. And all of a sudden, folks who ought to be in coalition are seeing any attempt at this as maybe grabbing the small part that I have. So I feel like you have excellent information here, and Janet, you certainly have had so much experience in other realms to help us think about this, but it feels like we almost need a full scale kind of attempt at simplistic enough to pitch why we believe these changes need to be made, but be open enough to really understand why folks like Best and other key legislators and even the treasurer himself right now just won't get them.
I
I think,
completely agree.
excellent point.
We need a holistic approach, stepping back from the pieces and parts really, and getting back to that foundational premise that this is intergenerational. What does that mean? And it's easier to ignore opportunities such as earning more money in the fund that will happen tomorrow. That's easier to ignore than actually the cost of not solving this, which is really, that cost of not solving it is borne by all of the stakeholders and the beneficiaries here. And it's that message of, in a private trust setting, you have the future beneficiaries who think that they're losing something, sue the trust. I mean, you read about this all the time, right? So there is really sort of a legal, in one sense of it, a legal liability and risk here to all the participants making decisions today at the cost and the expense of future benefits. So I feel like there's a lot of different components, and considering the costs and the opportunities and the strategy, and then the outreach of the various stakeholders, that I think this can be done because it's the right thing to do, but it is going to take a really, I think, comprehensive strategy involving all of them.
And probably several steps to that.
Has the best board and land board ever got together?
There was a best representative on the task force, but I don't think we've ever shared any time with the best board.
Yeah, I mean, if a joint meeting with the best board, it feels like kind of, and not just come hear what we think is good for you, but listen to what are their issues and why they're resistant.
The numbers speak, I'm sorry, but I mean, the numbers speak for themselves. We're not even covering, like we talked about inflation. We're selling properties, I bet you, even if we put it all into the permanent fund, wouldn't even keep up with inflation.
Yeah.
It's,
I don't want to dive too much into tactics, but just the best board is really just sort of a grant making board. And if you really want influence, it needs to be State Department of Ed.
Yeah.
Because that is the board
Okay.
above the best board.
I
But I get your point. Like, how do we, and we have gotten letters of support from CDE in the past that said, we understand the problem you're trying to fix and we support you, but it has not been an advocacy
There's a new
thing.
commissioner.
There is a new commissioner of ed.
There is, yeah.
So there might be an opportunity.
And I don't think sitting here we can determine strategy, but I feel like, first of all, it's not your role, Bill, or Janet's role, and you all are, it's our role And as you just said, as fiduciaries of a trust, you know, you could look at Hawaii or some of these other places that have had those suits and if you're not carrying out your fiduciary responsibility, it's an issue. But, you know, I don't fear that. I think we're sort of going along. But at this point, we have an opportunity, I think, to at least make a full-scale effort to figure out who our allies could be and try to figure out ways to work with them to achieve as many of these as possible. I have to say, well, it's nice to put in number 6. We all know that when you're working on a budget and you're not working in public, that folks are going to see a pot of money and they're going to sweep it, and that will happen every year.
Yep.
I am aware of Janet's time. Any last thoughts for us, Janet?
Or even response to that, Karen?
I think that what you just, I can't see the people in the room clearly, but everything that just got said made an infinite amount of sense. Because Bill and I talk and we're so convicted and that this is the right thing to do for the trust and for the children of Colorado. And it's hard for me sometimes to understand why people don't see it our way. and I think that it's, you know, I think that this meeting with the beneficiaries and maybe helping them understand and understanding their concerns. And I think Bill's been trying to do that, but that can't hurt. And so I think that all made a huge amount of sense to me.
Thank you. We appreciate your time on your vacation with us.
Yeah.
Janet, thanks so
Thank
much for
you.
taking the time.
Yeah.
Really appreciate it.
Thank you very much for letting me dial in virtually. Appreciate it.
Safe travels.
Bye.
All right. We're at 9:27. I think we should take a break. You want to come back at like 9:40-ish? We're always terrible. We'll be back at 9:45, but let's say 9:40.
Okay,
All right, thank you.
thanks for hanging in. I
Yeah.
thought there might be. No.
Oh, I didn't know she was going that way.
Commissioner Scanlon had to step out briefly. And let me just note for the record that the report from the DNR, which was listed on the agenda, will not be presented this morning. And we're going to go ahead on continuing the discussion on the item on the agenda, which regards the asset allocation of the permanent trust and recommendations from staff. So let me ask first if there are any additional points you want to make, Bill, before we move on a conversation.
Just that I've been working at this for 7 years and haven't moved the ball much. We've, gotten a couple pieces of legislation run. We've made some improvements at the margins, but it's going to be a team game, and we're going to need to as you've said, we're going to need to be in front of the right people, understanding their objections. We've discussed some of the people we know aren't going to be with us, and we're going to need a strategy to overcome that. And so I just welcome all your help and all your thoughts. I can't do this alone. So I need a new strategy. So thank you for your support. And thank you for, I guess I should say, it sounds like you've all leaned in and agreed that this is an issue and we need to solve it and we need to solve it now. So I appreciate that we've checked that box and now let's figure out how we're going to do it.
And I think it seems that there's concurrence too, that without getting into tactics, that the how involves a sort of broader conversation about stakeholders, interests, potential champions, and a really coherent, holistic strategy, which then would be part of conversations with many of those parties. Is that what I'm hearing?
Yeah, like we're talking, it's a good time. And I mentioned the properties that are potentially or will be sold over the next few years. And it does nothing. Even if we put all that money into the permanent fund, we're still not even making interest. And we can show people we're selling assets and it's not even, we're not even keeping up with. I mean, I know we're doing it for other reasons, but it's a good example of the situation we're in.
I think another example that stays in my mind is in the March meeting just before the pandemic, where we had, 200 or 300 people in that room when we were talking about grazing fees and potentially raising grazing fees. And I'm thinking we're trying to get blood out of a turnip in one place, when in fact we could be doing a much more strategic job here. And it just feels like that it's time to address. All right, so let me see if there are any other comments, and if not, we should. Bill, do you need anything else right now?
No.
All right, so in terms of the items that potentially could be property achievement looking for the agenda, any other questions about the things that have been listed on our agenda as potential items there? Right.
I can start into 23-24 business goals. But I'd love to have Commissioner Scanlon's thoughts on
Alright.
that.
Would
We
it be
could-
possible to move ahead to the hunting and fishing access program? Abe, are you ready for
Yep,
that?
so that's the public voting session of the meeting. Could I suggest we stay with the information item and do the solid minerals business plan and the staff report also?
Sure,
Well,
excuse
we
me,
for Commissioner
you're
Scanlon.
absolutely right, I skipped forward and didn't mean to do that, thank you.
Second, Ben.
Yep.
So. All right, we're on item 3C, solid minerals business plan, and we welcome Ben Tisch.
Hello, and thank you, commissioners. For the record, this is Benjamin Teschner, the Solid Minerals Manager for the State Land Board, and I'm here to present the Solid Minerals Business Plan update for 2023. The first, as a sort of a framing for this item, these business plans help guide staff on how we should approach our various business lines, the types of things that we want to focus on, and hopefully gets some, if not a voting item here, but at least some direction or feedback from the board that what I present here is a reasonable path forward and should sort of guide my thinking and to a lesser extent, the rest of staff's thinking about how we manage solid minerals over the next 5 years. So the first business plan for solid minerals was put together in 2013, I believe. And so this is the third update to that plan. The picture on your screen here is the gypsum mine on our Table Mountain property, and the gypsum that you see here eventually ends up at the Pueblo cement plant and becomes an ingredient in that cement that you saw yesterday on our tour.
Or the one-stop resource for those guys.
We sure are. Yeah. I mean, it's a really neat story that we get to tell. in the spirit of these bang slides, I'm really living into this, and I have 3 bang slides because I think there's 3 overarching ideas that we're trying to hit here with solid minerals. The first is that this is an industry, the mining industry is an industry that is in something of a transition. We're transitioning away from sort of an old energy economy and into a new energy economy. And so I want to be aligning our leasing with this new energy economy, including things like solar, renewable energy, nuclear, all these kind of low carbon energy sources, and all of the infrastructure and things that we need in order to do that. Second, I want to be aligning our leasing with the needs of growing Colorado, right? And primarily this means construction materials, which you'll see is a big piece of our solid minerals program, and a large example of which is the Pueblo cement plant that you saw yesterday. And third, transitioning our leases, particularly in legacy commodities like coal, into their next productive use. And here you can see a picture of a reclaimed, this is the Trapper mine. And this is an area where there was a large hole in the ground for a coal mine, and probably about a decade ago. And now looks like this. And this is one of our colleagues from Division of Reclamation, Mining and Safety out doing an inspection of this property, looking at species diversity and things like that to approve a bond release for Trapper mine to say, job well done. Let's move on to the next use. And so this is what that property looked like 10 years ago, and has made that transition at this point. So this is a picture I took at the Trapper mine only a couple years ago. And so I want to sort of start with this, where are we now, and show this picture of a coal mine, because coal is such an important part of our current solid minerals revenue portfolio. And that's something I want you to have in your mind as we move ahead and talk about where we're headed. As we zoom out a little bit on this program, this is a breakdown of our leasing by, this is in your board packet as well, but this is really our leasing by district. And the thing I want to highlight here is that the solid minerals program is heavily heavily into the Northwest District, primarily because that's where our coal properties are for the most part, and the South Central District, which is a really growing market, particularly for construction materials. And so 70% of our solid minerals leases are in those 2 districts, and 86% of the leased acreage is in those 2 districts. I put this up here to justify, in part, my expense reports to Pueblo and Craig. And the other thing I want to highlight is that this program has a total of 86 leases, and 56% of them are in construction materials. This makes sense in large part because you need a lot of these, this aligns more or less with the mining industry, of which most of the mines in the world are for construction materials. And so it's no surprise that our leases are that as well. All right. When we look at revenue, there's a couple things I want to point out here. This sort of donut represents the total 100% of the solid minerals program. And one of the big takeaways I want to show you here is that coal number. It remains 2/3 of our current revenue is from coal. And that represents about $3.5 million, something in that neighborhood. To balance that, metals is currently almost nothing. And this to me is where this is the teeter-totter that we're seeing with the new energy and the needs of the new energy economy as we move towards electric vehicles, wind turbines, solar panels, increased electrification of all kinds of things in our world. Our world needs a lot more metals, and hopefully we can be strategic about leasing for metals as we see the declines in coal. The other thing I want to point out here is our sand, gravel, and stone, and our limestone, which collectively make up our construction materials portfolio. This is about 1/3 of our portfolio at the moment. And this is 1/3 of our portfolio because a decade ago, and even before that, my predecessor and other folks in this agency made a conscious decision that we were going to lease more for this. And so you're seeing the results of that effort by staff and by the direction of this board to get into those businesses, and it's been successful. So I want to kind of give kudos to those who came before me. Another sort of important piece here is back in 2013, as early as 2013, the board recognized that coal was a declining asset. And we wanted to be thinking about this program and reporting our growth in this program in non-coal terms. And so when you see the business plan readout that I give you every year, it reports the big headline number is our non-coal revenue and non-coal growth. And so that makes up this area I've highlighted in black. And there's some interesting sort of fallout from that decision that in the context of the whole program will be important. So I'm going to walk through coal, construction materials, and metals, and then kind of wrap up at the end, because I think those three buckets have some interesting strategies and different approaches that we might take from a business management perspective. So let's start with coal. Coal is the legacy of the solid minerals program. It continues to be an important revenue generator, but as I mentioned, this is an asset in decline. The photo you see here is your staff on a tour of the 20-mile underground coal mine in Routt County. And the big context for coal right now is that our coal leases feed the Hayden Power Plant and the Craig Station Power Plant, both of which are slated for closure in 2028. Both of our mines have come to me and said we are exploring other markets for our coal. I think it would be responsible for us to assume that these mines close at the closure of these power plants. And so we're looking at probably the last production late 2027, maybe 2028, somewhere in that range from these coal mines, and should expect our coal revenues to decrease dramatically, especially past 2028. So as I mentioned, coal declining asset, right? And so our strategy here is to, I think, promote production on our existing leases. There's a finite amount of coal that it's going to take to power Hayden and Craig between now and their closure date. And we want as much of that coal to come from state leases as opposed to other places in order to help meet our fiduciary responsibilities. You approved a royalty rate reduction extension at 20 Mile a few months ago, maybe it was over a year ago, that aligns with this goal, right, to promote the production of our coal versus some other coal. And then we also need to be facilitating reclamation of these properties into their next productive use, right? That is currently happening. The Trapper mine and the Kalawayo mine, which is currently not producing state coal anymore, but the Trapper mine is. Those two are going to be our big surface coal properties that we want to be thinking about what's next. Maybe it's solar, maybe it's wildlife habitat. Whatever those things are, it's going to take a long time to get to that point, but it's something we need to be thinking about in the context of this resource. Next is construction materials, and I call these our bread and butter because this is the steady, most steady, reliable revenue that this program has. It's experiencing solid incremental growth, and it's because of the construction needs here in Colorado and in our neighboring states. This is a photo of the GCC cement plant that you saw yesterday, which is not only an excellent example of this type of resource, but is also, this lease is our largest non-coal revenue generator that generates a little bit shy of $1 million a year. Another example of this is our Red Canyon quarry on our Table Mountain property in Fremont County. And this is a drone photo. And, again, you're looking at a really large mine here. And this is, I believe, our second largest non-coal payer. And so this quarry produces crushed stone for all kinds of infrastructure along the Front Range, particularly the Colorado Springs Pueblo market. But also as part of this portfolio, we have pits that look like this one. And this is the whole pit in this photo. And this is a county pit. And this is a pit that, in this photo has seen a little bit of recent production. But for the most part, these pits are small. They're only a handful of acres and they don't produce a lot of revenue for us. But past boards have indicated that this is an important leasing program for us as well, because they help our counties maintain their infrastructure and things like that. And so something that we want to continue, right? These are also relatively low impact because of their size and limited production. So the big strategies here are when we think about this path of development, this is something we talk about in the real estate context a lot, like what are the properties that are in the path of development? We also want to be thinking about construction materials, because construction materials are what we call place value commodities. They are often more, it's often more costly to transport the commodity than the commodity is actually worth. So the pressure that the construction materials industry is in is they are trying to develop mines as close to the projects in which they serve as possible, right? And so that means you want your crushed stone mine as close to downtown Colorado Springs as possible. You want your as close to downtown Denver as possible. And that is in an obvious tension for permitting and other things, right? But as we have these properties that come up, that means that it's something I want you as our board members to be thinking about when we think about what properties are appropriate for what uses. We should anticipate incremental growth in this program. Hopefully we can get some, as our current mines exhaust themselves, we would expect sort of new mines to come along and replace them. And also that we'll see incremental growth in royalties as we, increase those within the bounds of our leases. And from a messaging standpoint, I think it's important that we connect that our leasing for these materials is part of we are serving local construction needs. We are serving counties. We are serving the folks that are building our highways. We are serving the folks that are building our skyscrapers, our new housing developments, whatever that may be, as we get folks who come in and are interested in these projects. Now, finally, I want to talk about metals. And in my view, this is our future. This is our future because it's not just Colorado's future. It's not just the land board's future. This is the future of mining. If we are to meet our global 2050 goals of being net zero from a carbon perspective, we're going to need a lot of metals. This graph chart is in your board packet as well. And what this is showing, this came out from the IMF a handful of years ago. And this is projecting a 2050 scenario where we've gotten to net zero and the metals we will need based on what is currently available and what is anticipated to come online. And the commodities over to the right that are further down, the dots are further down on this graph, represent more and more anticipated supply shortage. And so there's a number of metals here, lithium, cobalt, and graphite, that are really important for these energy transition technologies. And the World Bank says that by 2050, we're going to have to increase production by 500% on these minerals, right? So we should anticipate in these and others on the end of this graph, enormous demand increase, and as a result, enormous value increase for the properties where these commodities exist. Metals is the place where within the solid minerals program that has coal replacing potential. If we can get a metals mine or two to come online, we're looking at replacing a coal mine. We might even be looking at replacing multiple coal mines, depending on the scale of that development. That said, we should expect long timelines for metals development. Permitting a mine in the United States of any type takes an average of 7 to 10 years. That's even longer with metals mines. right? The impacts of metals mines are larger, they are more complicated. They have more environmental impacts than your construction materials mines. And those are all things that need to be addressed. We need to receive public comment, all of those things. And so even if we lease for exploration for these today, we shouldn't expect these to come online from a royalty generating perspective for a decade, maybe longer. We should be asking ourselves if I&D funds could improve geologic understanding of our whole portfolio and drive interest to explore for these metals on our properties. I think that's a larger question maybe for another day, but something I want to kind of seed in your brains. And we need to be anticipating risks and regulatory hurdles as lessees come to us and say, I'm interested in leasing this particular property. Understanding that these really long timelines have, enormous uncertainty about, what resources may be there, particularly natural resources may be there or may not be there if we ever get to developing a mine on a property. The greatest risk to this program by far is long permitting timelines and public opposition, right? There is an inherent tension between the global needs for especially metals and to a lesser extent construction materials and interest in having these mines near communities and near the environmental resources that they impact, right? I'm going to show you a couple examples, both of which are in your board packet. Recently, the Boulder County Commissioners voted against renewing a permit for Cemex, which is a cement plant similar to the one you saw yesterday. This is not on state land board property, but nevertheless is a really good example of the public saying, we're really concerned about emissions and climate change, and we don't want those emissions in our community. From my perspective, that's a really interesting tension because, we're still consuming a lot of cement. And so we're really pushing these impacts over political borders more than, and, I don't think climate change really cares whether the emissions are emitted in Boulder County or Larimer County or Pueblo County or wherever, right? But this is something that we're seeing more and more. The second one that I want to draw your attention to is the Hitchrack Ranch Quarry. This is on state land board property, or was on state land board property, would have been. This was going to be a large crushed stone quarry between Colorado Springs and Colorado Springs and Canyon City. And if this had come online, which we were anticipating at the last business plan update, this would have generated $500,000 to $750,000 a year for the land board. This was a project that got right up to the edge of being permitted and did not get permitted. And so as a result, I encourage you to take a look. This is a very long, complicated story with a lot of ins and outs and what have you, to quote the Big Lebowski. But it's worth taking a look at. But the point is there was enormous amount of investment put into this project and it didn't go through. The knock-on effects of which are, one, there's no crushed stone mine for the state land board, but also companies who may be looking to invest in Colorado look at projects like this and say, is this where I want to be investing my capital into the next new mine? Should I be looking in other jurisdictions? And it decreases the value of our mineral portfolio.
What were they going to be mining for?
Crushed stone.
Oh, crushed stone. Okay.
Yeah. So from this permitting perspective, the big takeaways here that I want you to take away are that public opposition is often at odds with society's larger mine material needs. And this is a global problem, not just a Colorado problem. But as we demand more metals, more crushed stone, more cement, as individuals and as a society, we are seeing greater public opposition to mining projects. This is worldwide, but something that should be we should be conscious of as we're thinking about this. But second, that permitting authorities are clearly hearing public voices. So regardless of the merits of whether they should or should not be approving or denying projects, it's undeniable that the public is able to weigh in and that they are being heard. And to me, this should give us some encouragement that if we lease for a particular mining project, that when they begin to have the specifics of what the project is going to look like, and they go to DRMS, they go to the counties, the other permitting authorities that may be required, that those voices will be heard and included in the decision-making process. So what does the future of this program look like? I wanted to put this is really a shout out to Kristen, who helped us develop these really cool signs for many of our mining lessees. And this is up at the TZAC quarry on our Table Mountain property. And it says, "This mine quarry helps fund Colorado public schools." We've been putting these up at a number of sites around the state, particularly ones that are high visibility. And I love this especially because, we showed up with some posts and some things like that, and offered these to our lessees. And this is what happens when you give a sign to folks who work in a quarry. They put a giant rock there, drilled holes in it, and cemented our sign into the side of the road. This is why they do it and I don't. So, but this is a cool program. And so as you drive around the state, have a look for these signs. You may see them around. My overarching goal is to grow our non-coal revenue by 1.4 million over the next 5 years. This represents 10% growth per year. I think this is an aggressive goal, but I think it's a responsible goal. I think if I came to you trying to do any less than this in the private sector space, I would be laughed out of the room. So I want to be aiming to hit that as a fiduciary of this trust. A lot of that growth is going to look like what you see here. This is the Fremont Paving State Pit, where they are crushing gravel for, this is a construction materials mine. Today, our total revenue is about 1.8 million from this program, including coal. I want to walk through a quick little 5-year and then 10-year scenarios here. And this assumes that we hit our non-coal revenue targets, right? In 2028, assuming we get that growth from limestone and from sand and gravel, we're going to see such a precipitous decline in coal that we are going to see a total decline in the solid minerals revenue program from, down at least $1 million. It may be more than that if coal goes offline sooner. And we're going to see limestone and sand and gravel start to make up a much larger piece of our portfolio. I'm also aiming to increase our metals leasing. But as I said, that we shouldn't expect those revenues to come on for at least a decade, right? Because of the permitting timelines and things like that. If we get to 2033, I'm hoping that the portfolio looks something like this, where we have a third-ish distribution between sand, gravel, stone, limestone, and metals, right? I'm hoping that by 2033, we have at least one of these metals mines has come online and is starting to generate revenue. Right. But it's going to take us a decade to get back above where we are now from a revenue perspective because of this decline in coal. So how do we get there? These are our big goals in your board packet. Increase the understanding of our mineral assets. We've partnered with a number of organizations, including School of Mines, Colorado Geological Survey, and will continue to do so. And as I say, there's a bigger question about whether I&D funds could be helpful here. We want to continue to grow the quantity of our mineral leases, and the quantity being, I would add quantity of quality mineral leases that are likely to result in mines. We want to increase the revenue from our existing leases. This is primarily a construction materials goal, right? Where we want to be on top of our opportunities to increase royalties to keep up with the increasing market demands for these materials and the increased value of these materials. We want to be stewarding all of our mine affected properties into a post-mining use. This is something that's really in there for coal at the moment, but includes all of our mined assets. And we want to increase understanding of State Land Board's mission as a fiduciary of the trust and as a fiduciary of our land assets, or for our fiduciary for our beneficiaries, and our land assets are part of that use, but also that we are doing this in the context of state and global demand for the commodities we're leasing for. So with that, I'm happy to take questions, and I'd love some feedback from the board about this approach and how you see this program and how you'd like me to focus my efforts over the next 5 years. And this is this photo here is all of you fine folks, including many staff at the Trapper Mine back in, I believe it was May, when we went on that board meeting to Craig.
Do we have a basic inventory throughout the state of what we have? And I know you're gonna, work with
Yeah.
College of Mines to
Yeah,
develop
so
that further.
about, Crystal, when did CGS do that mapping project for us? 10 years ago, something like that. The Colorado Geological Survey did a desktop study of all of our properties, all of our mineral properties about 10 years ago, and ranked them sort of on a 1 to 5 level for metals, industrial minerals, including sand, gravel, those sorts of things, oil and gas, and coal. And so we have these maps publicly, they're on our map server, and you can click on them and you can see it's a really rough first pass, but at least gives you a shot at, this is more or less where these things exist. This is more or less where these things exist. I think that those maps are good as a first pass. I think there's more we can do. Particularly when we're talking about exploration for these new metals that are underexplored for at the moment, like lithium, like graphite. These are globally underexplored for and less well understood as far as mineral deposits go than things like copper, which will also be needed, but is a well understood commodity. So there's some opportunities, I think, for us to do some expand upon those studies when we're to be thinking about these sort of new energy economy metals. Especially and where they might be in our portfolio, because I don't think that's especially well understood at this moment.
Following up on Commissioner Chavez's question, is the science and technology to a point where for these metals that you showed, all these metals that we could hire somebody to go map this out opportunistically, even if it isn't on state land board land?
Sorry, can you rephrase that one more time?
Is the technology and the science to the point where if money wasn't an object, you could go map where these things are?
Is this technically possible? Kind of. Yeah. I think that the short answer is we can improve. I think what we're doing, what we'd be doing in this, or I imagine we'd be doing, is less putting a bullseye on this is the spot and more saying these are the areas that aren't any good, right? And so that really helps kind of narrow down where we need to be. The groundwork that's required for mineral exploration for these types of commodities is really, really extensive. At minimum, it requires somebody going out and stepping foot onto these properties, of which we have 4 million acres, right? And doing that work. I think we want to leave that work to our lessees, right? Especially we want to leave the drilling holes work to our lessees. Where I think we have an opportunity is to look at, there are some consultancies and things who are able to look at larger land portfolios and say, let's use some AI tools with some publicly available and maybe less publicly available information, geologic information, and say, where are the highest chances of these things occurring based on, sort of past where we know past deposits of these things are. And so we can look at similar geology and the like. So that's, I think, where we have some opportunity. And, I think under an ideal scenario, it would be really cool if we did that work and we're able to narrow down a handful of properties that we were then able to market as saying there might be something here, and maybe we start to use that to put out for competitive bid or something like that. I think that's a little ways down the line, but that's sort of an ideal scenario, I think, for us. Yeah.
Why do you say that's a little bit down the line? I mean, that's something.
Yeah. Well, I mean, I think there's a lot of steps we'd have to go through to get to that point. I think one of them being, it assumes that we get results that say they're likely, this is a good place to look. It's very possible we could do a lot of this work and get, maybe all the good places to look are in Nevada or right in Utah. So
Just, how does lithium occur? I mean, I read what you had here, but is it
yeah.
big or is it usually found where other metals are?
Yeah. So this is a good question. And I will preface this by saying I'm not a lithium expert. So I will tell you what, we just signed a lithium exploration lease. But there are a number of different ways you can get lithium. One of them is out of brines. So if you're, pumping briny fluid up a well, you can then evaporate off and you may have some lithium in there. That's one method. Another method is sort of your more traditional truck shovel type mining in a, hard rock deposit that has lithium in it. So there are different occurrences for lithium, and I think it remains to be seen which of them we have, if any, and whether those are attractive for private investment.
I just circling back around to the inventory question. I'll point out, I think it's an excellent business plan to start with. I think at some point, the reason it'll take a little time to decide what to do is you saw what the revenue potential is. So how much do we want to invest to chase the potential? We don't want to invest $5 million to chase 6 million, but do we want to invest a couple $100,000 to chase something? So I think there's more work to be done to decide, to understand what the cost benefit is.
Absolutely.
I just have one other regarding kind of that inventory question, but the other mines, other company or other landholders. I know there's the Climax mine doing molybdenum. Is there anything else in this state that you know of, or?
Yeah, so molybdenum is our big, from Colorado's perspective, that's our big mined metal. We tout that in all of our geology departments as this is our thing, right? We certainly have a lot of gold and silver deposits. Historically, there's only one major gold mine in Colorado at the moment, and unfortunately, it's the Cripple Creek and Victor mine. And unfortunately, there's a section 16 and a section 36, and the mine is right here, which is just an unfortunate, statistical occurrence of how our land was distributed. We don't have any molybdenum on our properties at the moment. So I wouldn't anticipate that we will. There is a chance. We have a copper exploration project down in San Miguel County. That's in the very early stages. We have a rare earths. It started out as a gold project, and in the process, they discovered they had some rare earths in the heavies. This is up in Moffat County. That is in, I'd say, moderate stages. We'll see whether they can make that go. We have the gold, lead, zinc property, the Zephyr property in Fremont County that is, I would say, also in its early stages as well. So there's projects around, and it's a little bit of in my view, all of these early stage metals projects, the chances of them becoming a mine are low. Right. And that's the nature of this business. And, from my perspective, our best shot is to lease fairly aggressively for exploration and then say, if somebody actually gets to that point where they think they really have something, then we can say, all right, is this something we really want to go ahead with, given, the risks and the benefits that may be there. So, but we won't know, until we get people out there drilling holes. You know, as they say in the mining industry, the drill rig is the truth teller, right? It's yeah, that actually pulls up the sample and says, is there anything here? And we won't know until we get more holes drilled on our properties.
By way of context, we bring these to you all. You know, the land board's bolted onto the side of state government, but we run this like a giant leasing company, and we have business managers, and just like you would in the private sector, they've got to understand our strengths, weaknesses, opportunities, threats, the political environment, the revenue potential, and this is the way that Ben can go set a course for how he's going to drive his business for the next 5 years. So while we don't ask you to vote on this, we want you to be aware of it and to provide us any input you've got and think about this like a business that he manages.
That's excellent. It's helpful for us, and I certainly appreciate getting in this form.
Thanks. And I'll add to that, that hopefully if I do my job right, I'm bringing you some of these things in the future that you will see, and hopefully they will align with, you will say, oh yes, we sent Ben out into the world to do these things, and now he is showing up with some of the fruits of that labor.
It was very well done. And it's a business.
Thank you. Thank you.
Thank you.
Thanks. Right, and apologies, I had to deal with a work issue because that's what happens when you're in a meeting. But I think we're back to Director Ryan.
So I'll cover quickly item B, 23-24 business plan goals. Every year we lay out with the entire staff through a staff meeting, some goals for the coming 12 months. And I guess I should say that these are kind of project-based. They're not reflective of the ongoing work that everybody does on a daily basis. You've got a job description and stuff you've got to get done and get through. So this is sort of additive to that. But the idea here is to continue to drive toward the bigger goals of our strategic plan. If we're going to eat the elephant, what are the bites we're going to take this year to eat the elephant? And so you'll see in the chart here, each of them has a captain. Those link to their individual performance objectives. So this is a document we also use to link everyone's individual performance to the big plan. It's a nice top-down and bottom-up way of linking everything we all do here. I mentioned we had an all-staff meeting in April. We get lots of ideas. We also hear you all during the meetings. You make comments that help focus us on some things we're going to try. We're looking at outside influences. We're looking at some of the governor's goals and how they may align with our goals. And so those are all the things that go into creating this. For the coming year, I guess I'd highlight a few things. One we already talked about is sort of how do we better achieve intergenerational equity by making some changes to our asset allocation and distribution policy. We've got 3 or 4 properties that we think could be ripe for RFPs for housing projects now. There's one at Granby, there's our parking lot at 9th and Grant, there's Dow Junction. So we want to try and get those out into the market. We've now got a leader for our water line of business. So one of them's around water and advancing that business plan that he brought to you last month. Crystal and Ben are working on our geologic carbon storage business. How do we become a real player in that this year? We've got lots of stewardship goals around getting not only ourselves, but our lessees to adopt sustainable grazing practices. You'll see in the staff report that we've got a session next month that we've invited a bunch of our lessees to, where we're trying to push out best practices to them. I love the leverage of that model because it's not just our land, it's their land also. From Nick's world in our operational excellence stuff, we want to continue to try and improve our ease of use for our customers, allow them to do more self-service, improve our own organization and accessibility of the data that we've got. We have massive amounts of data. How do we use that better? And then also internally focused is on ways to maintain and deepen our agency culture. I think we've got a really good culture, and yet we've got a shifting work environment. So how do we maintain the good people and the good practices in an environment where we're not together as much as we used to be. So that's some of the high level highlights I wanted to hit. I didn't bring any slides because you wouldn't have been able to see any of this on the screen anyway, but you've all read it in your books. Any comments, questions? Wanted you to be aware of strategically what we're trying to do for the next year.
I had a, go ahead, Josie. On, or just on some of these, like the implement sustainable ag best practices and state land, partnering with open-minded state and federal agencies. I guess one thing I never, can we get help, financial help from federal government? Can they give us money?
Mostly no, but that's not an absolute. So programs like NRCS Equip, the money goes
To lessee.
to the lessees.
Right.
I think what we had in mind, we said, partner with, there may be other programs where they can provide resources to us. There's one in there that may be an example where we've talked for a number of years about trying to do some research work associated with these large solar installations and doing enough baseline work before things are installed to understand soil condition, plant, like we saw yesterday. And you saw a lot of soil compaction and you saw green things coming out that weren't necessarily good green things, maybe weeds, but they were green. And so we've been talking to NRCS and they've been a willing partner to maybe do that annual monitoring for us or to pay somebody to do that. So I don't know if that answers your
But for
question.
the most part, it's through the lessee. I mean, we can't apply for CRP funds. If
No.
there was not a lessee on it, we cannot
Right.
do that. And
Right,
get
we're
the
looking
benefit
at,
of that.
some potential dry ups in the Republican River Basin right now. And
Right.
it looks like we can accept some of those funds.
Mhm.
So it's not an absolute no, but I would say, I think that was less about accepting funding than looking for collaborative
Technical
opportunities.
assistance.
The holistic management offers a lot of seminars. We've tried to bring in outside speakers from other organizations. Kavira tries to train the next generation of ranchers. How do we partner with them? Can we get some of our lessees interested in those programs? So we've got a great mailing list of people who own lots of land, including ourselves. And so I think it's bringing
And
all of those
resource-based.
resources to
Yeah.
the
Right.
table.
And my only point, I guess, I mean, in getting technical assistance, getting funds is the federal government has so much money floating around. I mean, just more money than we can imagine and they can't spend it. But we can't take it either. Is that constitution? Is it statutory or is it just our structure? I know it's probably a head question or.
It's probably, I probably don't know, I don't know all the answers to that. With NRCS, it's just a function of their rules, who they will. I don't think it's an issue of us accepting. I think it's an issue of who they can give to. So,
It's almost always dictated by the program rules, not by us.
Okay, oh, well, that's,
Rarely would there be a dollar that we say we can't.
yeah, sorry.
So I think it's most often dictated by the people giving the money.
Thank you.
I thought I said earlier, and now I'm having a hard time getting all the colors, but Greg, is there an item in here where we had talked about beginning the strategy of leasing fee revision or policy
Grazing rate,
revision
develop-
process over the
grazing,
next
yes.
2 or 3 years?
yeah, for the grazing. Yes, and we actually at the industry roundtable last week or 2 weeks ago told them we were going to get that process rolling in the next, within the next 6 months.
It's in the green and it's letter E-N.
Right, I thought I saw it, I
It
just
says,
couldn't find it again.
evaluate alternative methodologies for establishing state land board standard grazing rates.
Okay. Thank you.
Again, one of those ones where we're hearing your feedback and working that into our plans for the year.
Well, and that's, looking at the agency at least that require agricultural practices that improve water cycle. And some of those, I guess, would be incentive based if lessees, and that's part of that evaluation too, I
Yeah.
think.
I'm not sure if I'd say they're incentive based at this point.
Yeah.
I wouldn't rule it out. I mean, I'd like to think that the incentive for the lessee is their own ability to increase production. They lease a certain amount
Or
of land.
AUMs.
If they can increase the productivity of the land, they can increase their own credit, the number of cattle they run or their profitability, and that we shouldn't have to pay them to do that, but maybe I'm the only one who thinks that way.
No, I'm not, I disagree.
One of the, I think it's under Christopher's business plan, we talked about, and you mentioned identifying a research partner on the solar lands. And I went to a presentation recently on EPA and the new money they have available. I mean, it's pretty amazing, that kinds of things that seem like they might align with some of ours. And I don't know if there's a written piece I can find out.
Yeah, we'd like to learn more
Yeah,
about that. Okay.
There might be some possibilities.
Mhm.
I see the wheels trying to miss their question.
I did wonder, tying together sort of the asset allocation discussion and, our overweight in eastern grasslands. And wondering if we had done with partners or otherwise, any kind of longitudinal studies, both for the past and then forecasting into the future, temperatures and conditions relative to climate change over the next 10 to 20 years. When I think of the value of those assets in a water constrained environment and with climate, as we think we know where it's going, it would have a big impact on value.
Yeah, we have not done that. And it's an interesting idea.
That I've seen various studies and reports have been at kind of a course level.
Mhm.
I don't know if it's even available, but anyway, it seems like many more people are doing much more reading on a more concentrated geographical area than just large regions that I'd seen, 5 years ago.
Okay.
So it might be something to look into.
It's a long to-do list for
Yeah.
some of it. You'll see a year from now.
Oh, it may not be in your, I mean,
Yeah, they don't all fit neatly into 12-month cycles, but.
Yeah.
So.
Terrific.
Mhm.
Our staff report is in our board book.
Yep.
And I didn't know, Bill, if you had anything to comment.
Get a
on
couple of
that.
highlights, we're gonna have another record year revenue. We already passed last year, which was a record. I mentioned earlier, we're doing an adaptive grazing management course for our lessees. How many folks are signed up for that at this point?
We have 4 lessons, which is, we didn't want more than 2.
Right, because it gets really specific about their properties. Chico Basin Ranch RFP is out in the market, and we've got mandatory tours scheduled in next week, I guess. Lots of interest in that. Our drought map looks good. Crystal and Mindy are going to conferences and learning lots of good things. On the Lowry Ranch Advisory Committee, like a good legislature that creates committees that sunset, we're sunsetting a committee here. We started this 10 years ago when we didn't have a great lessee and we hadn't made a lot of the strides we've made in the interim. Since then, we've dramatically improved the asset, and we've found that we really have a hard time getting folks who are interested in this who aren't lessees. And so we're going to sunset that committee. I think it's appropriate because it's served its purpose at the time we were leasing this out for oil and gas. We needed something like this. Now we've got a great lessee in place, a great asset management plan for the property, and this is difficult to staff. We can still tap into the expertise, but doing it in the formal way we were doing it here, we're letting that go. So we wanted to.
That's a great indication of success and sort of just a milestone. I'd like to shine a little spotlight on it.
Thank you.
What amazing progress has been made in that asset. Yep.
Absolutely.
Those are the things I wanted to hit.
All right.
Any questions from any of you?
Bill, do you want to just make a brief mention of the Assistant Director for Lands participation in the process?
The position that was handled by Doug Millstack And then Doug went over to BLM, and that's been getting sort of staffed by a variety of interim folks for a little while. I was on the interview team. We recommended 2 people to go forward to Dan Gibbs. Dan has interviewed both and was checking references. I asked yesterday if an offer had been made. I don't think it has, but Dan's got a candidate that I think will be a really good candidate and a good interface between DNR and the governor's office and the legislature for us. And also brings a wealth of statewide policy experience on natural resource issues. So hope to have that position filled here anytime now. But I was pleased to be able to, this is someone who's important to us, and so I was able to be on the interview.
What's the position name again?
It's the Assistant Director for Lands, Wildlife, and something else. But it's sort of a policy advisor to Gibbs.
Would that be similar to the gentleman yesterday, Aaron?
Yep.
When the energy,
Aaron's is on the new energy
so
economy,
it just
basically.
okay,
and-
focused, he's on that and.
Yep.
All right, very good. Okay, we're all ready. We can shift gears to our meeting. And just to open it up again, we have shifted our agenda a bit, so we spent the morning on business before the board, that is reflected on both our agenda and our board book. And we had an executive session, but we're ready to move on to the meeting part of our agenda. And the first thing we want to do is open for public comment. Anything that is not an agenda item on today's agenda, we did. I also want to note that we have received email comments that hopefully you all have, and those are always entered into the record. So just to note that as well. So Nick, if we have anyone online?
Yeah, folks, if listening along online, if you'd like to address the board with comments for things that are not on our agenda today, you can use the raise hand feature on the Zoom viewer, and we'll bring you to the fore so you can address the commissioners directly. I'll wait just a few seconds for hands. I'm not seeing any hands raised, Commissioner.
Okay, I appreciate that. All right, we will move forward. Director Ryan, we've heard from you so much this morning. Any announcements?
No announcements.
Okay.
I also want to report that Vanessa Mazzal was supposed to be with us today for the DNR report, and she is ill and not joining us.
Okay,
So we're going to skip right over that as well and go on to.
final action?
Yep.
All right. First is agenda item, final action item A with A. There you go. Come on up.
Morning, Commissioners. A Medina Recreation Program Manager with the State Land Board. Oops. So this morning I'm here to present to you the State Trust Land Hunting and Fishing Access Program. This board approval, or the board approval that we'll be asking for this morning, will continue an existing 30-year program that provides public hunting and fishing access to almost 1 million acres of state trust land. That's about a little over a third of state trust land in Colorado. Staff will recommend board approval of this agreement, and just for clarity, so and for anybody who might be online, this program used to be called, or was previously referred to as a public access program. I'll discuss a little bit more about the name change in a minute, but
I would just like to say, I think the name change is a really good suggestion.
thank you. Let's see, so the State Trust Land Hunting and Fishing Access Program, as previously mentioned, this is a lease between the State Land Board and Colorado Parks and Wildlife. This agreement has been in place since 1993.
That's clever.
This did not, my slide didn't update, but yeah. As mentioned, this program has been in place for 30 years. This year, 2023 is the 30-year anniversary of the program. As mentioned, this is, and this is the shift on this. This is a public use lease, allows limited access to state trust land in the program for hunting and fishing access only. And again, the acres in this program are almost 1 million acres of trust land. And as mentioned, it's about 34% of state trust land in Colorado. So this map on the screen does show, it shows both trust land in blue and then trust land in the program in orange. As you can see, it is dispersed all across Colorado. There are a number, there, and I'm sorry, it is dispersed all across Colorado. And again, almost 1/3 of all state trust land is in the program. So there's more detail about, kind of the program and this lease that we're approving, or that we're asking for approval in the board packet that went to the board this month. However, there's 2 important items that I just want to point out about this current renewal. First, the name is changed to State Trust Land Hunting and Fishing Access Program. And there's primary reason for that recommended change was the previous name Public Access Program meant a lot of things to the general public. And there was a lot of misunderstanding as to what that allowed. A lot of folks tended to believe that state trust land that was in this program had free or had public access to it year round for a variety of different uses, much like you would assume on a public park or a public open space area. So this name change really narrows it down and says specifically what this program is intended to do. It's provide that hunting and fishing access to the general public. And again, just on properties that are enrolled in the program. Also, this lease renewal does limit the allowed public uses to just hunting and fishing access. That's important because the previous lease did include a provision that allowed wildlife watching as well within enrolled lands. While the general intent was to, allow folks to get out and see wildlife on some of these on some of the properties, and it wasn't a lot of them. There's 450 properties in this lease. Only 12 of them allowed that wildlife watching, but folks would then misinterpret that the wildlife, well, essentially it became difficult for Parks and Wildlife staff to enforce the wildlife watching rule because folks could be out on a property walking their dog and just say, well, I'm wildlife watching. So, this definitely helps out, helps to make it very clear that it's just the hunting and fishing access that's provided as part of it. And it'll make Parks and Wildlife's job, their field staff, their job a little bit easier as well in the long run. So those were the 2 important changes with this lease. As mentioned, there is more detail in the board packet cover sheet that was in this month's agenda.
They should have added only.
So with that, staff is recommending that the board approve a 10-year lease to Colorado Parks and Wildlife for the State Trust Land Hunting and Fishing Access Program.
The CPW board approved this.
The CPW board approved this last month as part of their consent agenda. The renewal.
As did the Capital Development Committee of the Legislature.
Yep. So this also had to be reviewed by Capital Development Committee, and they approved it as well last couple weeks ago for the funding to continue paying the lease.
The rates, do those rise over time, with inflation or whatever?
Yeah, that's a good question. Yeah, the lease rate is tied to the CPI for the Denver, Boulder, Aurora area. So it does increase over time, and that helps it make sure that it stays in line with inflation.
Right. Thank you.
It is a long-term lease, and that's a very important component. So thank you. Yeah.
Thank you for including the, the concerns, but then the fact that rancher reported conflicts were only 3 and seemed fairly minor, but
Yes. Yeah.
it's good to know that before we approve.
Yeah. That continues to be a bit of an enigma. It came up at the Ag Roundtable a couple weeks ago. So the enigma is anecdotally, people continue to tell us there are conflicts and they're having conflicts. And then we continue to point out to them that there are at least 3 places in 3 different ways that they can report those in a way that they get recorded and acted on. So I don't think it materially changes what Abe put in the memo, but I will just point out, I would continue to wrestle with the difference between, I think, perception and reality and people's willingness to report and engage in a way that we can actually respond to. So it's a little challenge, but I don't think it's anywhere near what it was in the past.
I think it's definitely appreciated by the agricultural community that we have ways for them to communicate with us, about issues that they may have or experience as part of having the public share the land during hunting seasons. I will also mention at the agricultural roundtable, we also mentioned to the agricultural community that there was this name change coming, and all of them appreciated that name change. It makes it a lot clearer, and makes it a lot easier for folks to understand. So they did express their appreciation for that.
Slightly off topic, but what is the Ag Roundtable? Who sponsors that?
We sponsor it. Sort of anecdotally, I resisted it for a long time. I hated the idea.
It turned out to be great.
Turned out to be a really good idea. So I can still learn. We invite about 15 different industry representatives from CCA and the other cattle people groups and corn growers and wheat growers and the bison people and the farm union. And it's a pretty good cross section. We get pretty good attendance. We do it twice a year, and there was mutual agreement after a while that once a year was adequate. So we now do it once a year, try to do it off season when, after calving and before.
Right, kind of like May-ish, it sounds like.
Yeah, May, June. You're welcome to attend. We can let you know when the next one comes up, but
We were there last time. We had.
Yeah, I'd love to attend. I
Yes.
think of this.
The agendas are usually things, we review all the policies we've updated or changed over the last year. We ask them for input, and if they've raised questions about, this time it was historically, it's been tell us more about solar or ecosystem services or recreational leasing. This time staff did really good presentations on geothermal, solar,
Carbon storage.
Geologic carbon storage, a couple other things. And what's funny, we scheduled 2.5 hours, and the last 45 minutes is supposed to be the round table where we just go around, and we never get to that because the dialogue's been so sort of robust along the way that we probably cover everything, but it's just, I think, an indicator of how engaged they've been.
Is it on Zoom?
It's not public, but the agendas and everyone invited. Because the point is that the industry leaders relay the information to the organizations.
We did a hybrid.
I was just
during,
curious how you manage them.
Yeah, we did a hybrid during COVID, and we've sort of come back to in person like that, but we could always do
Probably
it.
get better, more direct
We
insights.
get clearer.
Yeah. I just have a question, Abe. I mean, there was such a flurry of activity following the legislation to find more acreage to put into this program. Where's that stand today? I mean, is CPW helping to grow more? I mean, we did like a pretty thorough review from my perspective of what might be appropriate, I guess is the word.
Yeah, no, that's a good question. We did the 3-year expansion of the program from 2018 to 2021 and added close to 500,000 acres during that time frame. And we did go through a pretty good review for field staff, both State Land Board and CPW as to what might come into the program. And I think what we found near the end of the 3rd year of that expansion was we were starting to find that there were the lands that were coming in at the time near the end had low wildlife hunting values. So I think we've gotten to a point where CPW is not eager to grow the program anymore. We what the good stuff is in the program.
Yeah,
So, yeah.
which is curious.
Just more broadly to your question, I think there's getting way ahead of my actual knowledge here, but I've sensed that there's been a push to grow more state parks. So you saw the big state park
Yeah.
down by Trinidad, there's Sweetwater Lake that's still in process. There's also a focus on trying to make the state park system more financially sustainable. And so that's where you saw the license plate or the fees with renewals.
Registration.
So I think there are lots of ways that the governor's office is sort of pushing public access, and this was just one of several.
Yeah, although I don't think that the representatives of the hunting industry continue to express interest in more state trust land becoming available. I think CPW, as Abe said, would say we're not willing to pay for any more because the quality is not, there's no hunting, there's no meaningful hunting opportunity being presented to the public. So I would say
Yeah.
you may continue to hear from members of the public or certain organizations that they want more access. I don't think CPW is willing to pay for it.
That's just a little random, but I did note with some humor that maybe we could have just called it the hunting access program because it's limited to September through February. I mean, it doesn't seem like fishing.
That's a,
Ice fishing.
that's a
Oh, that's good.
That's a good observation. We do have the properties, and there's not a lot of properties where we have fishing opportunities available. I think again, it's probably less than 15. So those properties are actually open year round for fishing. So they do allow for that. But yeah, good observation.
All right, there's no further discussion. We do have a board order in our packet. And we'll need a motion and a vote.
Public comment or anything.
Oh, no, I forget that all the time. Thank you. Any public comment, Nick, that we might have related to this agenda item?
Listeners online, use that raise hand feature. I'll give you 10 seconds to click on that button if you want to. No raised hands, Commissioner.
Okay. All right, with that, back to our board order. Do we have a motion?
Madam Chair, I move the adoption of the hunting and fishing access program as shown in our board packet on June 15th.
Thank you.
I
And
second that.
motion, Commissioner Heath, second, Commissioner Probe. We will call a vote. Commissioner Probe,
Aye.
Commissioner Heath.
Aye.
Commissioner Chavez.
Yes.
And the chair votes yes, that passes 4-0.
Thank you, Commissioner.
An agenda, I meant to raise something during the items that were not on the agenda. And it is this, as we've gotten those emails from various people about the solar project up near Norwood. Who responds to those emails?
So they're generally they're usually coming through our online public comment form.
We got, I think it was on a solar part.
Right, and we
So-
get those fairly often.
Yeah.
Yeah.
Different sorts.
So the process is, I'm Kristen Pimp, outreach officer. The process is that folks can use our online public comment form, and the form requires the person to indicate what they want us to do with their comment. Do they want us to bring it? Do they want it shared with the commissioners? Do they want a staff member to respond? So when they indicate they want it shared with the commissioners, of course we do that, and that's why you receive it. And then in every instance, the appropriate staff person responds when a response is needed.
Okay, so all of these folks will hear back something on their,
They always
Ones that
get,
Asked to.
okay, thank you.
and they always get a confirmation that their comment was received.
Thank you.
I just want to add also on that particular topic, I think it highlighted for me again that our process works. That we have a planning lease process. So we had a lessee come in and say, I want exclusive rights over this area. And we said, great, you've got 3 years to go get your permits and then come back to us. And so they're now starting to roll that out in that community. and getting the feedback from the community there. And so it's the public has the opportunity to comment through the permitting process there locally before it comes back to us for a production lease. So I like the way we've built the process both for that line of business and several others, where we want there to be local authority. So.
And do those get passed on to the applicant as well?
No.
Well, I think we didn't do that, but I can tell you from reading all the news clippings that the folks have been actively engaged in the process down there. So we've been tracking it through, Google News alerts and other sources. So.
I think it's just gonna always be an ongoing question. It's a little confusing to the public where our role begins and ends.
Yeah.
And so, this is mid-process in terms of a local planning decision, but we acknowledge that and recognize that as part of our record too, which I think is important. Okay, we're on to final action items B and C with Justin.
Justin's joining us remotely.
Hi, everyone. Can you hear me all right?
Ooh.
Yes.
Too much, maybe?
Maybe a little.
Didn't want that.
I'll quiet it down a little bit. I'll tone it down a little bit here. Let me pull up the slideshow. Can everybody see the slideshow all right?
Yes.
All right, great. Well, good late morning. I think we're starting to push against we'll get close to noon here pretty quick. For the record, I'm Justin Bieri. I'm the Water Program Manager for the Colorado State Land Board. Last month, we took a look at the water rights management and leasing policy. And also last month, it started raining, and it's been raining since, and it's been fantastic. The recharge pond that we visited last month has been taking water basically all month. So it's been great. But today, I'm bringing back to you for your consideration the water rights management and leasing policy, which is a final action item. And your board packet included a description of the different edits and responses from last month's discussion of the policy. The board packet also included a red line version of the policy and a clean version. Today, we'll review what policy is for, what it is and what it's for. We'll provide a little bit of a refresher of what the water policy included. And then we'll also discuss any questions and the changes that were updated in the policy. Keep in mind, this is a new policy. Even though we saw it last month, it's still not quite enacted. So see if I can figure out slides. Perfect. Okay. The water rights policy. So what policy is for? The water rights policy is to guide staff and to delegate some authority for staff to act on behalf of you all. And it solidifies or codifies lease terms, and it forms the basis for administrative procedures and guidelines. Policy is really the foundation of a program, and it provides the guide rails for staff to act within that program. If an item is not addressed in policy or a lease term is outside the bounds of policy, the item or issue is brought to you all for a decision. All right, so the water policy specifically is a delegation of authority to staff to address these 4 topics that you see on the slide: the acquisitions and dispositions of water specific assets, management practices again of water assets, the leasing and lease terms of water assets. So last month we went over a broad summary of the water rights policy, and specific items were addressed. I'll go over those specific items and address any questions you may have about any of the policy really. So the first these items aren't in any particular order. I think they just came as they came in order through the policy, the draft policy last month. So the first item that we'll discuss is the depletions or lag depletions. The issue we've attempted to address with addressing lag depletions within policy is if a depletion, a water depletion is created by a lessee on state land board property, and those lag depletions outlast the lessee or the lease and even the existence of the lessee. Some of those depletions can last decades and even hundreds of years, in which case the lessee won't be around and the state land board will be around and may be held responsible for the replacement of those depletions. Just to give you an example, when down in Division 2 along the Arkansas River, the Horse Creek Water Users Association and the Horse Creek that's tributary to the Arkansas River, when it came about, the engineering was showing that depletions along Horse Creek would have an effect on the Arkansas River hundreds of years. And so they said, you know what, we're gonna just count that as a totally separate thing. We have wells, we have assets within the Horse Creek area. And then there's other places along the South Platte that have been calculated to be depletive out into the hundreds of years. And so again, this is just to try to address that. So yes, the lessee is responsible for the depletions, and we want to make sure that the land board is covered in the event that the responsible party no longer exists and those depletions are still owed, basically. I hope that makes sense. Okay. Leasing. So last month, there was a concern about some policy language that appeared to lend itself more toward auction bidders, basically with the deepest pockets. This wasn't the intent of the language, and hopefully the policy modifications help clarify that. The modifications I'm referring to are specifically in section 3 and then subsections B and C. To be clear, I'm going to give a good example of this issue is leasing out an irrigation right. That irrigation right would not be available for lease for any other party who couldn't put the water to use for irrigation. Same is true for a municipal industrial water right. Agricultural producer, an irrigator, couldn't use municipal and industrial water right based on the decree for that use. It can't happen because of law. And we're basically codifying that in policy as well, that's something that we will not allow. So hopefully that makes sense. Last month, it was suggested that no subleasing would be allowed, and so that was added to the policy. And then finally, any change of a water right, for example, changing the use of the water right from one thing to another, that would require board approval. Also, whether it's temporary or it's permanent. So temporary, like a lease fallow, or permanent, like a dry up of an irrigation property, all those would require approval by you all. Okay. So want to talk briefly about lease terms. So on the screen, here's is just an overview of some of the lease terms that we've put in policy. So these are terms that staff can approve. Anything outside of these terms would come to the board for approval. So again, if it's greater than 10 years, it's going to come to you. If it's more than $50,000 a year, then it'll come to you. Anything that's out of the norm, I guess, and we're setting the norm here. So with that, staff recommends that the board approve the water rights management and leasing policy 300-012 giving staff authority to issue water leases and conduct other routine tasks related to this line of business. And with that, I suppose we'll answer questions, take comments.
Hey, Justin, Commissioner Chavez suggested is noted a couple of times in our board packet. I was just curious your thoughts.
No, I think the changes are, are good.
No, I appreciate the quick response and turning us back around to those clarification.
Yeah.
All right, I am not seeing further discussion. We will need a motion for this, and first we'll open it up to any public comment.
Members of the public, use the raise hand button. I'd like to address the board on this item. Got no raised hands. Commissioner.
Okay, all right. We do have a board order. Make a motion. All right, that'd be great.
I move that the board approve the water rights management and leasing policy described in our board order.
Excellent.
Well, second.
Motion Commissioner Frobe, second Commissioner Chavez, quick vote, Commissioner Frobe.
Yay.
Commissioner Heath.
Aye.
Commissioner Chavez.
Yes.
And the chair votes yes, that passes 4-0. All right, we're back to just.
Actually, this is Greg Okish, Assistant Director.
Greg is
I'm gonna
gonna be
try to take a
Justin.
whack at this one.
Okay.
And Justin's gonna bail me out when I fail. So as was noted in your board memo on this topic, and nobody seems to know how to pronounce it, Osier Spring is what I'll go with. We don't necessarily need a board action, given that you just passed the policy. We wrote the item not knowing if you would pass the policy, and if you hadn't, we would have had to ask you to take action on this. The Osier Spring water right has two components. We have, and by the way, I think this is a good example of how policy is partly intended to make the most efficient use out of board time, so that this wouldn't necessarily have to come to you in the future now. But the original water right has both a full right for agricultural use and for wildlife. But we applied and got a conditional right for domestic use. At the time, there was a thought that the board might develop a cabin or a hut or something on the top of this hill, and the spring could be used for that. One of the things I've asked Justin to do as he reviews our portfolio is identify water rights, probably in most cases, conditional water rights, because those are the ones that fit this definition, that the cost and energy put into trying to maintain the water right through water court diligence every 6 years exceeds any potential value that we might realize at the end. And this is one of those. We have alternatives. We can just drill a domestic well if we ever build a hut or a house and that's actually a much easier process and doesn't require ongoing diligence. And probably more importantly, in this case, we really haven't met our diligence obligations. I mean, we've met them according to the rules of the court. We got our diligence done 6 years ago, but the things we said we would do in the next 6 years, which to prove this up, which should have included additional engineering studies or the development of a hut so we could actually put the water right to use, so we weren't speculating. We're not done because we don't think the project has merit at this point. So rather than continue to spend time and energy on maintaining this very small conditional water right, staff would like to let it lapse. That was the item we were going to bring to you, and certainly we can talk about that. But given that you just passed the policy, staff's intention would be to not perform diligence on this water right this time around, and use our energy to do other things. So, can we answer any questions about that?
That makes sense.
Okay. So I don't know if we have to take action to pull this item off the agenda, Ed, or.
No, I don't think so.
Okay.
Okay. We just move on.
Yes.
Okay, all right, very good.
Thank you.
Very glad we passed the policy.
So
Yeah, I'm sure, I'm sure. All right, we're on to our leasing agenda. Nick, are you going to be Andy today?
I am gonna be Andy today. For the record, Nick Massey, Assistant Director on behalf of Andy Bissett, Transactions and Records Services Manager. Here to ask for your vote on the June board leasing agenda. As part of your packet, 13 leases go up on the agenda this month. Pretty active month. 7 competitive bids, an extension, and 5 brand new pieces of business. Details are provided in your memo as well. If you've got additional questions, I will do my best to point to a person in the room or online who can answer those. Otherwise, I would welcome a vote.
This is Commissioner Krause. Yeah, I just had one question regarding the Bear Creek, the annual lease. You probably don't know, but how did that compare to the averages? Because that was the point of a 1-year lease.
Yeah, what did we get?
$41 and
It compares very well. I mean, the standard rate is less than $20, certainly. So it's double the standard rate. Is William on?
It doesn't look like William's on.
Okay. We were very pleased with it.
He was there.
William just popped back in on my.
Okay, yeah, then I would defer to William to add to that.
They're the same.
We're promoting you, William.
Can you hear me?
Yes.
Hello, Commissioners. William Woolston, Field Operations Team Leader. To answer the question, against the average competitive bid, I don't have it up, but our average competitive bid last year was about around $30 over the year on on about 20 competitive bids. The Bear Creek bids ranged from 41 to $20.57 over 10 bids. So we got 5 bids that were $30 or more. So I felt good about the mix. Our the top group hit where we were hoping it would, and that's fairly normal. So it was a good competitive set of bids, good stewardship in quite a few of the applications as well. So it was a nice group to work through. And then of course they've got a very good recreation lease to add to the Bear Creek ag lease, seasonal lease as well.
All right, terrific. Thanks, William.
You're
Were there questions or discussion of commissioners? Right, before we ask for a motion, we'll open up for public comment, Nick.
Members of the public, if you'd like to address the board on anything on this agenda item, please use the raise hand feature. Is it a feature? Or is it
I think it's.
Commissioner, no raised hands.
Okay, with that, we will need a motion to approve the June board leasing agenda, if someone would like to do so.
Commissioner Chavez, I move we approve the board leasing agenda for June of 2023.
Thank you, Commissioner Chavez. Second. And second, Commissioner Heath. I'll call it quick vote. Commissioner Frobe. Yay. Commissioner Heath. Aye. Commissioner Chavez.
Yes.
And the chair votes yes, that passes 4-0. All right, we are down to our minutes. Did anyone have any changes to offer in reviewing the minutes? I believe so. So the minutes will be approved by acclamation. We will be going into executive session. We do an annual director review with Director Ryan. Commissioner Heath suggested we just do a fun thumbs up, thumbs down kind of thing, but so it might be brief, but nonetheless, we'll move into executive session. Do we need a moment to close out the meeting?
Folks grab lunches, they can eat. And then I'll just stay with the 4 of you in here. And everybody else can get on the road.
Yep.
And then just for the logistics on the recording,
We'll have
will
to-
take us in. We'll get to enter. On this.
Do you want to
recording.
do that now and go into executive session, and then we can grab lunch and all of that before our discussion starts? Okay.
And then we'll Beth plans to start a fresh recording for that piece. And everybody online will be dismissed and et cetera, et cetera.
Okay, very good. If you want to take this off and
Good afternoon. It's Ned Hammond, Assistant Attorney General.
Hold on one sec back there.
This is Ed Hamrick, Assistant Attorney General, and I represent the State Board of Land Commissioners. This afternoon, actually, I guess we're not, today, the Commissioner would like to go into executive session to discuss the Director's annual review. The Director has requested this be held in executive session as is permitted, and this executive session is authorized under section 24.6 402(3)(b)(1 of the Colorado Revised Statutes. The discussion will be limited to the review, and no decisions will be made in executive session.
thank you, Ed. Could we have a motion?
I so moved.
Motion Commissioner Probe and a second
Second.
Commissioner Heath. Commissioner, we'll call a vote. Commissioner Probe.
Yeah.
Commissioner Heath.
Aye.
Commissioner Chavez.
Yes.
And the chair votes yes. With that, we will move to executive session. Close out our meeting.
For the record, folks online, at this point, the public's session of the meeting is ended, and so will the webinar. Thank you for attending today. And that's all we have.
All right, take 5 minutes, get
Yeah,
ourselves
well.
reorganized.
Yeah, sure.